the global backdrop is healthy.
There are winners and losers that people are picking right now.
Underneath the surface, there is both tech and non-tech parts of the market that is driving that charge higher.
As an investor, you need to be on your toes and be ready for surprises.
There's definitely some dry powder coming for next year.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Good morning and Merry Christmas Eve. I'm Annmarie Hordern alongside Scarlett Fu. Jonathan is still on paternity leave and Lisa is on holiday, but we are ending the year with stocks hitting another record high yesterday, 38th for the S&P 500. GDP data, of course, for the third quarter came in strong, upside surprise, but consumer sentiment still under pressure. President Trump was out with a critique, Scarlett. Thank you for joining me this morning.
Pleasure to be here.
He had a critique for what he is calling, quote, the modern market.
Yeah, he doesn't like this whole good news is bad news. When there's good economic data, the market reacts negatively because they start to get worried about inflationary pressures and then start to think ahead to, oh, the Fed then needs to raise interest rates, and that causes stock prices to go down. He is not in favor of that. He wants the Fed to lower rates if the economy is doing well. Good news is good news.
He also had to say, alongside that Truth Social post, that anyone that doesn't agree with him will never be the Fed chair. And I just have to think, if you are someone like Rick Reeder, we know you have an interview next week after Christmas at Mar-a-Lago. How are you going to talk about where the economy is right now, especially as we are in this very precarious time? The Fed has already cut 3 times. You do have strong GDP, but at the consumer sentiment, what I found so interesting about the number yesterday was the fact that, and some of the anecdotes, that individuals not so much nervous about going out and purchasing. It's actually they're nervous about the labor market.
They're nervous. They're still spending, but they're nervous. And those nerves end up translating oftentimes into voting for a new candidate on election day. And that's certainly what the president doesn't want to see. I'm curious whether a Rick Reeder or any of the Fed chair candidates can explain the bad news is good news impulse in the markets as well. Not that President Trump wants to see bad economic news. That's anathema to him.
He doesn't. But that is what he calls the modern market takes its cues from. All right, let's take a look at where equities are trading this morning alongside the broader markets. You do have slightly muted, a little bit of a pullback on the S&P 500 futures. But as I said, 38th record high yesterday we had for the S&P 500, notching another record high as we go into Christmas. Looks like we're going to get that Santa Claus rally. Nothing really going on in the yield space this morning, 4.16% on your 10-year. All the action once again in the commodity space, gold and silver. Gold rose to an all-time high above $4,500 an ounce, and it is still holding on basically to those gains. And at the same time, we also have silver. Silver has risen 150% this year. Both of these commodities are on track for their best annual performance since 1979. Coming up in the program, Michael O'Rourke of Jones Trading with stocks at fresh record highs, Terry Haynes of Pangea Policy as the White House moves ahead with $100,000 fees for visas, and Tony Roma's CEO, Mina Hawk, on how the restaurant industry has navigated an uncertain year for the consumer. We begin this hour with stocks little changed as the Santa Claus rally lifts stocks to new all-time highs. Michael O'Rourke of Jones Trading writing, quote, "We doubt most investors realize how expensive the S&P 500 really is. There's no doubt in our mind it is a bubble. There is strong fundamental business demand, but what matters is the price an investor pays for it." Michael joins us now. Michael, thank you so much for joining us. So you're bursting the bubble a little bit this morning. How should we think about going into next year?
No, I think as we saw that GDP report, the economy is doing very well. Obviously, AI is driving a lot of spending, but we have asset prices are very, very much inflated. And, that quote has to do with the top 20 market cap names in the S&P 500 are trading about 40 times trailing earnings. And that's if you take out Tesla, and 28 times forward earnings. So that, those are historically high valuations, historically high multiples. And it's funny, you're just talking about the economy. I would say, we talk about the K-shaped economy, where the rich seem to get richer and everyone else is left behind. It's the same thing in the stock market. You have these top 20 names driving the overall market, or obviously even the Mag 8 will drive the overall market, but a lot of stocks are being left behind on a valuation basis. So there are many attractive names out there, but that's not where we are in the index level.
But do you still want to remain that exposure to some of those high flyers, those 20-odd names?
No, I think what we've seen in this market is the crowding into those mega cap names has led to crowding out of many other high quality blue chip names. So, for example, in the pharmaceutical sector, with everybody chasing Lilly because of Zepbound, and GLP drugs, a lot of large cap pharma names have seen their multiples depressed, PE multiples to single digits, and they're paying somewhere between a 3 to 6-7% dividend yield. So there are attractive areas to this market. I would rotate out of those bigger names and look down to the lower market caps, but still blue chip names out there in this market.
Down to the lower market caps, would you go so far as to start bidding up the small caps? Every single time they look like they're gaining some momentum, they kind of lose steam, and we start to see everyone rotate back into the big cap names because they can't get away from them.
Well, so the small caps are interesting because they're really, for the most part, an interest rate play or a Fed rate cut play. So most of the momentum we see go into the Russell 2000 or the S&P 600 has to do with, we got a bad piece of economic data. The Fed's going to lower rates, or inflation's coming in. I don't see they are more attractively valued. The S&P 600 and the S&P 400 more attractively valued than the S&P 500 on an index level. But you are, in a lot of cases, just bouncing around with Fed funds expectations. Whereas, like I said, there's a lot of blue chip companies out there, even in the consumer staples space, where you're seeing the multiples come in, and they're names that I think you're getting at a discount that you can put away for a long time because everyone's crowding into the mega caps and chasing this AI trade.
Yeah, you're talking about the bad news is good news dynamic, especially as it plays out for small caps. Michael, what do you worry about the most in 2026? In terms of potential landmines, what is the single biggest risk out there?
Well, I think this AI trade, I do think it's a bubble. I think there's massive speculation in the space. I think you're going to see some of these deals start to unwind or not come to fruition as far as funding rounds and things like that. And I think that's going to spook people. And, while the technology is phenomenal, I think what kind of was lost by a lot of investors is the disruption is pretty easy. And we got our first we saw a taste of that with DeepSeek early at the beginning of this year. But then last month, when Google came out with Gemini 3, people realized, oh, wow, someone could do this better and they could do it with cheaper chips. So I think that's a real risk to the so much money chasing the AI trade start going to this new year.
Michael, when you look at the third quarter GDP report, AI investment and household consumption by obviously the higher income Americans, that's 70% of the growth, those two components together for what we saw in the third quarter of GDP. Obviously, it's a rear view mirror, but that's where the money was spending, AI investment. So if you think that this is overdone, is it not just an issue for the stock market? Is this also a huge issue for the U.S. economy, the real economy?
Oh, I would think it is because that's where the growth is, right? Like you said, we talked about this K-shaped economy, and we have people worried about jobs. The labor market obviously has been under pressure since the summer. So if that slows down, it is an issue. I mean, I was looking at the contributions, to technology, investment over the course of this year. And I think it totaled or equaled, the past several years. So it's been strong throughout the year. And the question is, can you continue at the same pace, and can it continue to push this economy forward? Now, that said, the president has announced a lot of initiatives to increase investment in this country. And so, that appears to be coming through. So I do think we have to see that, how it plays out in Q1, Q2 of next year, because right now it doesn't seem like the momentum's stopping. But again, even a slowdown will be, a problem for stocks. Like what a lot of people forget is back in 2000, when the internet bubble popped, you still had companies like Cisco Systems growing their revenues at 50 and 60%, 9 to 12 months after their stock peaked. So there's still going to be fundamental growth out there. It's just that deceleration is what's going to spook investors.
Well, speaking of spooky investors, there were some concerns about the credit market. You had First Brands, Tricolor earlier this quarter. And of course, the AI bubble fears are starting to show up as well. I look at Oracle bonds and Oracle credit default swaps. Do you see those bubble fears that you mentioned earlier showing up first in credit markets? And if that's the case, are we starting to see it already?
Well, it is interesting because, as you brought up, we've seen that in the auto sector. So you've seen some weakness there. I mean, the tricky part with the credit space, the private credit space for the most part, is you really don't know where the true valuation is. We've seen some private credit funds list, and they wind up listing at, or in private real estate funds listing at 75% of NAV or 25% discount. So there's more underlying weakness out there. But again, it takes time to show up, without real pricing, without transparent pricing and market pricing. It's hard to tell. But again, if you have private credit managers get a little more cautious out there and not writing the loans for these projects or demanding tougher terms, again, that becomes another potential headwind for the market or for the economy.
Right. I think about the sell-side strategists and their forecasts for the market overall, and they are almost uniformly bullish, Michael. About 11% gain for the S&P 500 following 3 straight years of double-digit growth. It feels like everyone's already priced in everything, which then leaves room for external shocks, really damaging sentiment and therefore market pricing.
Yeah, I mean, when you look at the environment we're in, we have equity valuations are extremely rich. Whether you compare it to the Russell 3000 is about 240% of GDP. If you take public and private stocks, I think they're about 325 to 330% of GDP. These are record levels, right? Bloomberg Intelligence came up with a statistic that the largest 200 private companies, so their valuations increased by $2 trillion. And then you have the entire crypto space out there, which is another $3 trillion. So you have a lot of rich asset prices out there, and that will just make you more vulnerable to shocks should a bad piece of news come along.
Michael, thanks so much for joining us. Merry Christmas to you and your family. Michael O'Rourke of Jones Trading. Let's get you an update on stories we're watching elsewhere this morning. Yahira Anand is back with your Bloomberg Brief. Hey, Yahira.
Good morning, Annmarie. A federal judge says the Trump administration can move ahead with a $100,000 fee on new H-1B visa applications. Analysts say the ruling is a setback for U.S. tech companies that rely on hiring skilled foreign workers. But the judge says the president has the power to impose the fee under an express statutory grant of authority. The U.S. Chamber of Commerce, which sued to block the proposal, can appeal. Meanwhile, the U.S. is holding off on new Chinese chip tariffs until at least mid-2027, despite accusing Beijing of engaging in unfair trade practices in the sector. This comes as the U.S. Trade Representative's office released the findings of a nearly year-long inquiry into China's chip sector. The announcement focuses on so-called foundational semiconductors made in China, which are used in sectors such as autos and airplanes. And shares of Dynavax soaring 37% in the pre-market. Sanofi agreed to buy the California-based company for $2.2 billion. The French drug maker is trying to expand a vaccines business currently anchored by its flu shot franchise. The deal gives Sanofi a hepatitis B vaccine and an experimental shingles vaccine. That's your Bloomberg Brief. Annmarie.
Thanks so much, Yahira, and in there. We should be back with our brief and movers throughout the morning. Up next, the push to hire American.
So the whole idea is no more will these big tech companies or other big companies train foreign workers. They have to pay the government $100,000, then they have to pay the employee. So it's just not economic. Train Americans, stop bringing in people to take our jobs.
Terry Haynes of Pangea Policy joins us next on that story. You're watching Bloomberg Surveillance. And Merry Christmas. Welcome to Bloomberg Surveillance. I'm Annmarie Hordern. Scarlett Fu woke up early to join me this Christmas Eve morning. We have stock futures muted this morning, pulling back just ever so slightly. Yesterday, the S&P 500 had a new all-time high, the 38th all-time high for the year. So it does seem like we will get that Santa Claus rally. Under surveillance this morning, the push to hire Americans.
So the whole idea is no more will these big tech companies or other big companies train foreign workers. They have to pay the government $100,000, then they have to pay the employee. So it's just not economic. If you're going to train somebody, you're going to train one of the recent graduates from one of the great universities across our land. Train Americans, stop bringing in people to take our jobs.
Here's the latest. A federal judge ruled the Trump administration can move forward with a $100,000 fee on new H-1B visa applications. Bloomberg's Jonathan Tamari joins us now. Jonathan, this has been a huge debate within the GOP. Is this a win Trump has for his base?
Absolutely. I mean, the president has campaigned on restricting immigration, not just illegal immigration. He's restricting legal immigration. This is one way of doing it. And this is his administration's way of saying that these jobs that many tech companies are looking overseas for should go to Americans. And they're trying to make the price so prohibitive that they're going to be hiring more American people. As part of this lawsuit, they brought up examples of companies that laid off American workers and then petitioned to receive H-1B visas. And this is the way that they say they're fighting that.
Jonathan Tamari, thank you so much for joining us. I know we're going to have an update with you as well in 60 minutes time in the next hour. Joining us now is Terry Haynes of Pangea Policy. Terry, I got to ask you, what do you make of this? Because tech CEOs have been going to the White House, and I imagine this has been part of the discussion as well. They want to make sure that they could still get the best and the brightest workers into the United States.
Oh, sure. Merry Christmas, Annmarie, and to you and to Scarlett, first and most importantly. Yeah, they go to the White House and they talk about these things. But, you know, the tech CEOs have a long list, and we all know what they are. And the question is whether or not H-1Bs are at the very top of that list. And the answer is almost certainly they're not, compared to AI and antitrust and competition and a variety of other things. So, yeah, they are very important. But, you know, what you played with Lutnick there on the bumper has been very consistently the administration's policy that what it wants to do is not just keep those jobs here, but to train people up in the United States so that there's greater reliance on a United States workforce and, frankly, greater ability of that workforce to deal with the 21st century tech challenges in AI and elsewhere. So, this is not just a matter of the administration flexing its own power. It's got a policy point behind
Terry,
it.
though, the president in 2024 was on the All In podcast, and he said that what he wants to do is that if you graduate from a college, I think you should get automatically, as part of your diploma, a green card to be able to stay in this country. That includes junior colleges, too. What happened to that idea?
I think it probably got, I think they want an idea like that, but I think what ends up happening here is that it becomes less important when against the broader push on H-1Bs.
Terry, is this issue resolved? I mean, I know the U.S. Chamber of Commerce was the one that initiated the lawsuit in October, and we know that following this ruling, the Chamber of Commerce can certainly appeal the ruling. But in their mind, is this something that's pretty much a done deal, and the organizations they represent can kind of move forward?
Oh, I imagine they'll appeal it, Scarlett. You know, there's the thing that markets need to understand is that there are 677 United States district court judges. You know, there's always a district court judge making a ruling on something. There are 2 appeal levels above that. I have every confidence the Chamber of Commerce will continue to appeal. That said, the arguments the Chamber and a lot of other folks make, including the state of California, in trying to overturn this policy are telling all by itself. California, for example, said that one of the 2 of the reasons it was pushing back against the administration was because of the negative implications it would have for education and healthcare. Now, if you think more broadly about the kind of immigration policies that, say, Gavin Newsom is interested in, that the politicization of that becomes obvious.
Well, speaking of decisions that we're awaiting, of course, the Supreme Court is scheduled at some point in the new year to come out with its ruling on Trump's tariffs, those reciprocal tariffs. What's priced in right now? What is kind of the base case here? It seems as if, given the arguments that have been heard and the responses we've gotten from justices, it is that the Supreme Court will roll with those back.
The base case is that the tariffs go away. I'm very much non-consensus on this, as you might know, for two reasons. One is that the court does not dispute the fundamental seriousness of the economic emergency. In other words, the court's not trying to evaluate whether or not there is an economic emergency or not. That actually wasn't even, that wasn't among the questions presented, wasn't discussed, anything. Secondly, there are plenty of other tariff authorities that the president can use should this one be turned back. Thirdly, I think the court probably gives if there's an infirmity in the statute, the court probably gives the Congress an opportunity to correct it. And the Congress, in fact, will have that opportunity in what's now being called Big Beautiful Bill 2.0, reconciliation bill that I think comes up probably in the first quarter of calendar 26. So all this together means that the wishing and hoping that there's going to be some massive tariff rollback and people are going to get a windfall is completely off base.
Terry, when it comes to the GDP data yesterday, a lot of this is AI investment. You had Kevin Hassett speaking to some reporters talking about the boom in AI. Trump in November says he loves AI, he's not worried about it. How do you see this debate playing out in Washington, though, when you have individuals like Steve Bannon talking about constantly that AI might mean layoffs by more Americans?
The administration has made the decision that AI is the tail that wags the dog. I think that AI is the key to everything. Right or wrong, I think that's what they do. The national security strategy is very plain about that. The so-called Genesis mission or Genesis project that Trump announced is very plain about that. Even the Defense Department's draft report on the Chinese military threat that came out earlier this week is very plain on that. So I think that's beyond debate, frankly, within the administration. And I think that every policy, economic or otherwise, that gets discussed and decided through the AI prism.
I wonder what you make of the Gallup polling we had this week about Trump's approval rating, especially when it comes to the economy. Even among independents, his support has a low of 25%. Americans are just not feeling everything the administration is touting. Do you think potentially going to the midterm elections, they will make the same mistake the Biden administration made?
2 points. One is more obvious than the other, I think. One is that the midterms are almost a year away. And in a situation where you've got 10% or more of the House, which is really what's in play here, the tiny House majority, 10% or more of the House seats are not only open, but we're not sure entirely who's going to be running for them. I think it's awfully premature to assume that the Democrats will sweep those. Secondly, I do not think the administration is going to make the same mistake that it did that the Biden administration did on assuming everybody understands what they think and will conform to it. Finally, I think people need to understand that the president is the most popular politician in America. I carry no water for Trump by saying that. I will say that Trump's favorable, unfavorable last week was -9 compared to -14 for Republicans, -23 for Democrats overall. And that right track, wrong track since the 20th of January has improved roughly by half. Last week it was 16.5 roughly, and January 20th it was 32. They will attack the affordability problem strongly. They don't care about ideology. They'll attack it any way they can that makes sense, and they've got a lot of time to do it. So I don't look for success. I look for a completely different approach than the Biden people made.
Terry, thank you so much. And Merry Christmas to you and your family. Terry Haynes of Pangea Policy. Coming up in the program, our conversation with the American Airlines CEO, Robert Isom, on the state of travel heading into the holiday. Plus, Yahira is back with your morning movers. Nike is up as Apple CEO Tim Cook buys more than $2 million worth of shares. You're watching Bloomberg Surveillance. Good morning and Merry Christmas. Good morning and Merry Christmas. This is Bloomberg Surveillance. I'm Annmarie Hordern. Alongside Scarlet Food today, she was lucky enough to draw the short straw and join me very early in the morning. Jonathan Ferro is still on paternity leave, and Lisa is off for the week. We do have equity futures really muted Obviously, there's lots of low volume today because we are going into Christmas tomorrow. We should note that, though, the S&P 500 had another all-time high yesterday, the 38th all-time high of this year. Switch up the boards a little bit. We aren't really seeing much when it comes to the bond space, especially after what we saw yesterday, when we saw a little bit more red on the screen in terms of after that GDP print. And in the FX market, we have the dollar dropping for a third day. But once again, holiday volumes are thin, close to 118 on euro dollar this morning. We're 3 hours away from the cash open. Here's your morning movers with Yahira. Hey, Yahira.
Hi, Annmarie. Sanofi is shopping for growth, buying this company here, Dynavax, in a $2.2 billion cash deal to expand its vaccine portfolio. But the most fascinating part about this deal was the timing, because the statement came just minutes after U.S. regulators delivered a blow to Sanofi by surprisingly rejecting its drug for MS. But Dynavax, for its part, shares are soaring 37.5% in the pre-market. Also rising in the pre-market are Nike shares, up 2.2% after Apple CEO Tim Cook stepped in to buy the dip. He's on Nike's board, and he purchased nearly $3 million worth of shares after Nike disappointed with results last week, which sent the stock down more than 10%. We'll see if 2026 is Nike's turnaround year. Tim Cook seems to think so. And we end on AST Mobile. This is a space company taking on SpaceX. It just took a big step in the space race, so shares are up 2.2% after it launched its largest ever satellite from India. The goal is to beam cell service to smartphones here on Earth, putting it in direct competition with SpaceX's Starlink, and it plans to have dozens more launches in the next year. Annmarie.
Thanks so much, Yahira. So Tim Cook is the longest-serving member of Nike's board of directors. He's going out making this purchase, but you actually said maybe he's going to be the new brand ambassador?
He is often photographed wearing Nike sneakers, and like very custom, high-end Nike sneakers. The Sashiko Gals Nike Vomero Plus, he wore that in 2025, earlier this year. This was during an Apple Ginza store reopening. It was really featured during that time. He also wore the Nike Air Max 186 and the Nike Epic React Flyknit and Phantom React Flyknit as well. I mean, I don't even know what these
either do I, but
look like, but they sound impressive.
And clearly, he's a huge fan of them. All right, so maybe a low-key brand ambassador, influencer in Tim Cook for Nike. On our radar this morning, President Trump reiterating his call for lower interest rates, posting on Truth Social that the next Fed chair should ease policy if the market is doing well. Trump says, quote, "Anybody that disagrees with me will never be the Fed chairman." Okay, so keep that in mind, Rick Reeder, FYI, before you go sit down with the President of the United States next week at Mar-a-Lago for your interview. But in all seriousness, based on what I understand of how the president was conducting interviews in the first round, when he ultimately ended up with choosing Jay Powell, the one question he asked and cared about was, will you and are you willing to lower interest rates? That's the key question.
That is the key question, but also how they look and what they sound like as they're making their case to the White House and to the public matters a lot. We know the finalists, there's been this horse race between the different Kevins, Kevin Warsh, Kevin Hassett, Chris Waller is still in the mix as well. So I feel like the president's going to milk this one for as long as he can in order to create the most drama. I mean, he is a showman after all.
He is a showman. I mean, yesterday he did actually talked about he was the master of ceremonies for the Kennedy honors, and he said maybe if I do so well that
Trump Kennedy Center, excuse us.
Yes, and he said that maybe if I do so well, that's another career move he can have. But in all seriousness, the president does want to make this not just so much for the drama, but I always find that he does take his time with decisions that have to do with U.S. capital, with the financial markets. Think about how the Treasury race ran, and think about how the last Fed search ran. This Fed decision, we were supposed to have really in early fall. That's what I was told in April by Secretary Scott Bessent. Now we're not going to get this decision until 2026.
Yeah, he is thoughtful when it comes to something that affects global markets and global investors, because he knows that is one of the ultimate yardsticks by which people judge his administration. So yes, this is something that he's going to consider carefully, but we know, as you've pointed out, that he wants someone who wants lower interest rates. And ultimately, they want to reduce mortgage rates so that affordability in housing becomes something that is really a pillar of the Trump administration the second time around.
Going to be a huge debate how many times the Fed is able to cut next year. The White House also introducing plans to potentially expand coverage for Medicare and Medicaid to include GLP-1s for weight loss and diabetes. The model would allow the administration to negotiate directly with manufacturers for lower prices and standardized coverage. And elsewhere, commodities rising to new record highs as the everything rally takes hold into year end. Copper prices climbing to over $12,000 a ton, with gold, silver, and platinum all reaching new all-time highs, on track for their best year in decades. I mean, when you look at this, silver 150% for the year, gold up 70% for the year. And most people are saying the rally is relentless. It's going to continue into next year.
Right, especially for things like industrial metals like copper. You have increased demand for the AI build out. You also have in the rest of the world, perhaps not in the US, the clean energy build out, and copper is an important material for that. In addition, the ongoing questions about whether the US will tariff copper has led to a lot of stockpiling in the U.S., so there's a big difference between copper prices traded in London and in New York. Then you've got the shortages due to mine outages in Chile and Indonesia. So it's kind of a perfect storm for copper.
Absolutely. And when it comes to gold, you have central banks continuously buying. A lot of that has to do with U.S. policy as well. When we saw Russia's invasion of Ukraine, you saw a lot of central banks say, you know what, we're going to shrug some of our dollar holdings and actually put more of that capital into gold. Turning to travel now, airlines are in the midst of a record-breaking holiday season. Lisa Abramowicz sat down with American Airlines CEO Robert Isom and asked him about consumer demand.
Let's start with the holiday season. Everyone is getting ready to fly, sometimes with family, sometimes to family, sometimes to avoid family. What do the bookings look like so far?
We're really pleased with how we see the Christmas and New Year holidays shaping up, and even more so as we take a look out into the first quarter of 2026. You know, the government shutdown, it had a dampening effect on demand, but I really like what I've seen in terms of bookings post that, and we're ready. You know, an airline is a big, complex operation, and it takes people and equipment and, you know, systems to all be working. We've double, triple checked, and I'm so proud of our team. They're ready.
So we've heard from Delta, we've heard from United, we've heard from a number of other airlines about the hit to revenues in the fourth quarter as a result of the government shutdown. I don't believe that American has come out with anything like that. Do you have some sort of estimate of what type of revenue was lost due to the cancellations during the government shutdown?
Well, it's just been a month ago that we were talking about our third quarter earnings and talking about what we were envisioning for the fourth quarter, and really optimistic about bookings that had happened. And at the time, we were, you know, in the midst of government shutdown, but the impact was fairly light. You know, at the time, we were saying less than $1 million, you know, per day. But as things developed and then we got to the mandated pullbacks, look, there was an impact, and it was substantial. And it not only was it for the day of travel and the cancellations that might have happened or the disruptions, but it was also for the bookings that would have happened during that period. And so there was a dampening effect during the period. Again, the good news is that as soon as we get out of that disruption, as soon as we get to really having an airline system that people have confidence in, they come back to travel. And so that's what gives me great optimism for the holidays and as we look into the first quarter.
I have to be honest, when I talk to people in the industry, the sense of palpable frustration that this is sort of the hot potato in any kind of negotiation is really notable, especially heading into potentially another government shutdown in January. Is there anything you can do to get ahead of it?
Well, I don't like that. Aviation is critical infrastructure to the country. And I think everybody in the administration, everybody in the House and Senate realize that. We have to do the things to keep critical infrastructure running. And while it's commercial aviation, I'd also say, you know, other, you know, really important industries, drones and eVTOLs and anything that's taking into account air mobility depends on air traffic control. And we can't use it, you know, really as a battleground. So I'm confident that our politicians will get together and figure out a way. It starts with protecting our air traffic controllers. Nobody should be asked to come to work and not be paid. And nobody should be used as a pawn in a political negotiation. So I'm really hopeful that by the time we get into January, this will be long behind us.
In the meantime, the airline industry is incredibly competitive, as you know. And we've heard Delta and United talk about their premium offering, talk about increasing their revenue. United in particular particular. Scott Kirby has come out and said that United and Delta are kind of taking off and apart from American Airlines. How are you fighting back, given that that's the backdrop that you have?
Well, wouldn't they like to be so? It's absolutely not. It's absolutely not true. And as a matter of fact, you take a look at American Airlines history. We were the ones that developed the frequent flyer programs and airport lounges and the hub and spoke system and global distribution systems. There's just an ethos of innovation at American Airlines. And really the investments that we've made over the last decade are all set to come about and be ready for where customers want to go. So I was flying back from London over the weekend in our new flagship suite on our 787-9P. And I can tell you that hands down, that is the best product among any of the network carriers in terms of experience. This year, we've announced the opening of the new Philadelphia flagship lounge. We've got a Miami flagship and a Charlotte flagship coming. Nobody has more premium quality lounges than American Airlines. We're going to do a better job of packaging this all together. We have an extreme focus on customer experience. We've got a new organization that's just totally dedicated to that. And just about every week, there's a new announcement with Lavazza Coffee, our Champagne Bollinger, or Raven and Lily amenity kits. I'm really excited about that all being packaged, and us, certainly, talking about that in a fashion that people understand. We've got the best loyalty program, we've got the best product, and it's where people should be flying.
One thing that American Airlines has for it is it's more focused on the domestic regime than some of the other competitors. And I'm just wondering if there's an effort to sort of expand the international network as that does become a higher margin offering for so many airlines.
Well, that's right. And this year, that exposure to the domestic region, it had an adverse impact on us. We didn't have as much international exposure. International did very well over the course of the year. Domestic, not so much so. We had uncertainty, the accident with 5342. So there was a lot of things that we had to overcome, and we've done that. But I feel really good about where we're headed. And when it comes to international, we're ready.
That was Lisa Abramowicz with American Airlines CEO Robert Isom. Let's get you an update on stories elsewhere this morning. Yahira is back with your Bloomberg Brief. Hey, Yahira.
Hi, Annmarie. We start with the latest on the war in Ukraine. Ukrainian President Volodymyr Zelensky says his country and the U.S. remain split primarily on territorial issues and talks on a peace plan to end the war. Ukraine rejects Russia's demand to give up land in eastern Donetsk, fearing it would leave the country vulnerable to a new Russian attack. Now the latest on the rollout of the Jeffrey Epstein files. The Justice Department has released the second batch of documents from its investigation into the late sex offender. Many of them contain references to President Trump, including a 2020 email from a prosecutor that detailed Trump's trips on Epstein's private plane in the 1990s. President Trump has said those trips never took place. And the U.S. Supreme Court has refused to let President Trump deploy National Guard troops in Chicago. A majority of judges ruled that the administration failed to identify a source of authority that would allow the military to execute the laws. The move is a setback to Trump's drive to use the military in cities across the country. That's your Bloomberg Brief. Annmarie.
Thank you so much, Yahira. Up next, the state of the consumer.
The consumer's in pretty good shape, spending more money, employed and earning more money, but differences between different types of consumers, and then being wise in how they spend. If they, if they trade down, and all the things you're hearing the retailers talk about are true, but the aggregate amount of moving in the economy is still growing.
Nina Hawk of Tony Romo's joins us next. You're watching Bloomberg Surveillance. Merry Christmas and good morning. This is Bloomberg Surveillance. I'm Annmarie Hordern alongside Scarlett Food. Today, we do have equity futures pulling back just ever so slightly, but S&P 500 yesterday hit a new all-time record high, 38th of the year. All the action once again this week in the commodity space. Gold, silver. Gold is up 70% this year. Silver is up 150% this year. And what you hear from the street, what you hear from analysts is they expect this rally in the commodity space to continue. Moving on, under surveillance this morning, the state of the consumer.
The American consumer spending at 4% more November this year versus November last year is a very solid backdrop. The consumer's in pretty good shape, spending more money, employed and earning more money, but differences between different types of consumers, and then being wise in how they spend. If they trade down, and all the things you're hearing the retailers talk about are true, but the aggregate amount of moving in the economy is still growing.
Here's the latest. U.S. consumer confidence falling for its fifth consecutive month as negative views around the labor market and business conditions persist. Mina Hawk, the CEO of the international restaurant chain Tony Roma's, writes, low confidence and sticky price perceptions are influencing dine-in frequency and check size. Mina joins us now. Mina, thank you so much for joining us, especially on this Christmas Eve. Give us a sense of what you've seen change with the consumer this year.
Thank you for having me. For consumers at Tony Roma's, as you know, we are located all over the world and the United States. While there is a perceived value because of the macroeconomic factors of, where we get reviews of people showing frustration about the price of the menu. However, when I look at the sales data over the last 4 years, I am seeing system-wide, we are progressively seeing a sharp increase.
So when it comes to what does that mean when consumers are at the actual restaurant, are they still coming in and just going for less options, potentially ordering less off the menu? Are they looking for days when potentially, I don't know if you run any sort of promos? How are you actually weathering this storm?
So from a consumer point of view, what happened is let's say they like our ribs, right? And they try to compare the data maybe from a year or two ago. However, in our system, we try to keep the pricing quite stable. We don't try to pass any difference to consumers because of any macroeconomic factors. But when it comes to pricing, yes, we do run promos. There are deals. There are limited time offers where our franchise partners, if they want, they can participate in it. In units where they are participating in these promos, they are seeing a very sharp increase in consumer demand.
Let's talk a little bit about beef prices, because that's something that's obviously featuring prominently on your menus. We've seen beef prices go up 2.1% for ground beef in September. That is up 15% from a year ago. How is that being folded into your menu offerings and menu pricing? I know that you say you don't want to be raising prices, but at some point, the margins on that, the costs on that become kind of onerous.
Yes, I agree with you. There are many macroeconomic headwinds out there right now, but this also gives us the opportunity to look into the microeconomics of our unit and see what we can do. When it comes to pricing, our initial reaction is not to pass those differences to consumers. But are we feeling pressure? Yes, we are. The margins are thin. Restaurant industry overall operates on a very thin margin. But in my opinion, what I am seeing is the macroeconomic factors are actually allowing us to look into the restaurant systems overall and see where are opportunities to cut back on cost. While the food cost, it is high because of various reasons, but are there many options? Are there enough suppliers? How can we diversify our supply ecosystem? These are the questions we are asking internally, while before, maybe the restaurants operated on a status quo for many years.
And I appreciate your saying that. So can you give us some more specific examples of your cutting back on costs that in a way that might be visible to your customer?
For example, one of the biggest areas of cost is labor. While we like to protect the jobs and make sure that our workforce remains competitive, due to AI and the technological innovation, that is one area where we can see some more opportunities to be far more efficient. Our corporate staff size have reduced drastically, but we are much more efficient due to the technological advancements.
So are you basically saying that because of AI, you were able to shed some employees?
We're not shedding employees. What we're doing is, let's say, if there were 5 employees at the corporate level doing a work, because of AI, the turnaround of projects, the data integration have become much faster. We have robotic server in some of our select locations, but we are not cutting back on employees. But what we are becoming is much more efficient. The work of each and every employee, where I see it is, because of AI and the data integration, will become a lot easier, and the operation will be much more efficient.
When you're looking for 2026, anything you can tell us on maybe expansion plans or any changes in the menu?
In terms of expansion plan, we just reopened in Guam. We had a presence in Guam for a very long time. A local military couple just recently, last week, reopened our Guam unit. And with the very remodeled and it's modern, and the local military community is extremely enjoying the Tony Romas over there. We are going back to Calgary. The energy sector over there is doing a comeback, and Calgary is a very vital market for us. We're anticipating an opening in Q2. We are growing in Asia Pacific. We are looking into the Middle East as well.
Okay, so even as you undergo this expansion, we know that Tony Roma's is a 50-year-old restaurant brand. There's a certain brand legacy that you need to protect even as you adapt it for the 2020s. And even this latest tweak can backfire sometimes. I think about the backlash to Cracker Barrel's logo change. How do you modernize the Tony Roma's look and experience without alienating customers in the process?
When we're modernizing it, we are not, changing our logo, our brand palette, because that's how our customers identify with us. What we're doing is internally, we're trying to see where are the areas of improvement.
Thank you so much, Mina, for spending your Christmas Eve morning with us. That, of course, is Tony Roma's CEO, Mina Hawk. Great question, Scarlett. I was thinking about that when it comes to the restaurant industry. The one story that stuck with me all year was Cracker Barrel.
It's such a cautionary tale.
Absolutely. What do you do? And to Mina's point, she's saying you don't want to touch that.
Yes.
Something that's very traditional, you don't want to touch that.
And if you do it very incrementally. You're not going to do a drastic change. I mean, I think about that logo every time I drive on certain highways because you see the Cracker Barrel sign and the billboards everywhere.
And what we've seen since July is actually that the stock has actually continuously suffered from that.
Yep.
I think it helped that it got some press for a while. Even the White House and Trump was weighing in at one point for it.
It was a cultural moment.
But in the end, I guess the line is you don't want to break or fix what's not broken.
I think that's a good way of putting it.
Yes. All right, coming up in the program, Cameron Dawson of New Edge Wealth, Mattel CEO Ynon Kreiz, and Joyce Atatu of Vincent & Ekins International. You're watching Bloomberg Surveillance on this Christmas Eve morning. Volumes are low. We do have equity futures in the red, but nothing to fret about the Santa Claus rally right now. The S&P 500 had a 38th record high of the year just yesterday.
And we're still looking at double-digit gains for a now fourth year. So
yes, so the bull market continues.
The global backdrop is healthy.
There are winners and losers that people are picking right now.
Underneath the surface, there is both tech and non-tech parts of the market that is driving that charge higher.
As an investor, you need to be on your toes and be ready for surprises.
There's definitely some dry powder coming for next year.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Good morning and Merry Christmas. Merry Christmas Eve. I'm Annmarie Hordern alongside Scarlett Fu this morning. Jonathan is still on paternity leave and Lisa is on holiday. We are ending the year with stocks hitting another record high, the 38th for the S&P 500 yesterday at the close. Yesterday we got GDP data for the third quarter. It came in strong, but consumer sentiment is under pressure. What I found so interesting as well from the Consumer Conference Board was that consumers are worried about the labor market and where potentially they might get their next leg higher in terms of wages and pay growth. President Trump come out right after all of that data and how the market was reacting. Scarlett, he was critical of what he calls the modern market, and then he had a few choice words to say for his future Fed chairman.
Yeah, and I think this is super interesting because when he gets good economic data, he thinks the market should celebrate that. And what we've seen, of course, is this worry among investors that the good data suggests that the economy is doing well enough that inflation could be a problem again. And so therefore, that might lead to interest rate hikes or at least a less dovish Fed. And you see stock prices and other risky assets decline. That's the opposite of what he wants to see. He wants good data to mean good news for the market.
The problem right now with this data, at least the data we got yesterday, and then, of course, the Conference Board sentiment survey, the data is so stale. It was before the government shut down. And you're seeing some analysts say that actually we saw people want to buy ahead of the holidays, especially if they're worried if some corporations were going to start passing on some of the tariffs.
The stockpiling.
Yeah, so what really is going to matter is the data, the inflation data and the jobs data we get in January.
Right, and the other problem there is that we might get another government shutdown in late January as well. So the data is not going to be clean for a while, right? I mean, if you're looking for January data, that's not going to come until February. So it's going to be a while.
It's going to be a while. Volumes low this morning as we check in on the markets. Of course, that is because many of you are maybe working from home or not working at all. You do have S&P 500 futures pulling back ever so slightly. 38th record high yesterday. We are basically muted and unchanged. Scarlett, all the action once again. The commodity space, absolute tear. That's just today's intraday. This year, gold is up 70%, silver up 150%, best year since 1979.
Yeah, those gains don't really do this year's advances any justice, right? Because gold up 70%, silver up 150%. It's not just a precious metal, it's also an industrial metal, and there's a lot of demand for these industrial metals. Platinum, copper, silver. You have things like the AI build-out. You also have, outside the U.S., the build-out of green energy. All of that means there's a lot of demand for those materials at a time when there are question marks, especially for copper, about U.S. tariffs, too.
Right. We knew that President Trump does love to use tariffs, and this has been weighing on copper really for the last 2 quarters. Individuals are weighing whether or not he is going to increase that tariff rate. Coming in the program, Cameron Dawson of New Edge Wealth with stocks at an all-time high. The Mattel CEO on how the toy maker is mitigating tariff risk ahead of Christmas. Then we'll get an update on the dolls. And Joyce Attitude of Vinson and Elkins on charting a path to possible tariff refunds. We begin this hour with stocks little changed following the S&P 500 closing at another record. Cameron Dawson of New Edge Wealth saying equities are undeniably expensive and there are signs of complacency, but this market can chop to new highs. Cameron joins us now. Cameron, give us a sense of what new highs, and Merry Christmas to you, what new highs we can have when it comes to equity markets next year.
Well, good morning and Merry Christmas. I think it's time to dust off the old adage, which is respect the trend, but don't ignore the risks as we go into 2026. Respecting the trend appreciates the fact that we're still very much in an uptrend in this market, and it's also being led by pro-cyclical areas. You mentioned industrial commodities. Earlier, you also have leadership in things like banks as well as transport starting to turn higher. So there's a pro-cyclical message coming out of this market. And you also have a very important uptrend in earnings estimates and GDP estimates. And this has been the key fundamental underpinning as to why we keep being able to press to new highs. As long as you're revising estimates higher, that's usually a good environment for risk taking. So the second half of that is don't ignore the risks. And that's where we look at things like valuations. We look at signs of things like complacency within markets, look at the VIX turning ever lower each and every day. And so it could be in an environment where we're still able to carve out new highs because of those earnings estimates, but there could be some volatility and chop along the way simply because you have a high bar with valuations and a high bar with expectations as well.
But you still think positioning is not yet stretched. What would get us to that point?
Our favorite measure is looking at the Deutsche Bank consolidated equity positioning, and this is really measuring institutional positioning. And what's fascinating there is that we're in the 62nd percentile, which is just about slightly overweight. But if you look at discretionary investors, they're still just neutral. And so we think that there's still room for more people to get dragged into this market. But if we're talking about positioning, we also have to mention households as well. And that's where you cannot make the argument that people are underweight equities. You can look look at the AAII survey that looks at equity positioning, that's at the highest level it's been since peaks like 2018 and 2022. We've talked a lot about how margin loans have grown extraordinarily over the last 6 months at about a 40% clip. So there are certainly signs that households are very fully invested, but some institutional investors have still sat on the sidelines, which just is likely why over the last 6 months or so, every dip has gotten bought so rather quickly.
Yeah, talk a little bit more about that money that's sitting on the sidelines, the dry powder, if you will. We've talked a lot in the past about money market funds and how there's more than $7 trillion of money just sitting there waiting to be deployed. Maybe retail investors are fully invested, but that doesn't take away from the fact that there's always that possibility they could put more into the market. How are you thinking about what it would take to get that money to be put to work?
Yeah, we've never considered the money market funds as exactly fungible funds that could go into equities, meaning that these were savings and cash balances that were typically held in cash savings accounts versus just things that were anxious and waiting to go into equities. So maybe at the margin, as you see those money market funds start to fall, it does incentivize people to look for other investments, but it's not necessarily a direct line straight into the equity market. So certainly, money market rates falling could push investors into looking into other areas instead of just sitting on the sidelines and clipping coupons, but not necessarily $7 trillion of a wall of money that will go into equities.
So the Santa rally that we have right now, how much of it is driven by technical factors like positioning versus true fundamentals, earnings growth, and the earnings outlook for 2026?
Yeah, this time of year, we try not to read too much into the price action given volumes being so very light. And we do know that there tends to be some kind of window dressing and positioning chases into year end. And what's really fascinating is that we saw the rotation in leadership start a little early this year. Typically, we see leadership rotations where you have your classic dogs of the Dow or the last shall be first trade that kicks off in January as people start to rebalance portfolios in a new tax year. But it seemed to start in November this year, where we saw value, for example, outperform growth by 5% since November 1st. So maybe people are trying to get a little bit ahead of that. But at the end of the day, we try not to read too much into very end of year kind of price action, simply because it doesn't reflect anything more than likely just positioning chasing.
Cameron, when it comes to the commodity space, if you look at what happened this year across the entire spectrum, gold, silver, platinum, copper, do you look at that and you think you have to maintain part of this into 2026, or do you think individuals should make sure that commodities are part of their portfolio?
Yeah, we see commodities as a way to have an inflation hedge within portfolios, and they work really well when they work well, and they don't work so well a good portion of the time. So certainly we've been in an environment where that has been a very powerful uptrend for a lot of these commodities. I think the question is, how much can it continue? Jeff DeGraff of Renaissance Macro put out a great piece effectively saying, hey, when you've doubled your return in less than 2 years, the probability of you doing it again is extraordinarily low. So it gets back to this kind of overall notion of respecting uptrends and not ignoring risks. Gold is in a very powerful uptrend. We've been calling it the Chuck Norris of commodities. Nothing seems to be able to keep it down. It doesn't even touch its 50-day moving average. But if you look at longer term charts, it is extraordinarily overbought. So it wouldn't be surprising to see some kind of consolidation. But we do know that there still remains very powerful drivers of, for example, central bank buying of gold, but also appreciate it has become somewhat memeified, meaning that it has become effectively a momentum stock. You're seeing a lot of trading in retail investors as well as investors overseas. So it could get a little bit over its skis and consolidate, but the uptrend is still very much there.
Gold is now a meme. Cameron, thank you for that. Cameron Dawson of New Edge Wealth will be sticking with us. Let's get you an update now on stories elsewhere this morning. Here's your Bloomberg brief with Yahira. Hey, Yahira.
Hi, Annmarie. A private jet carrying Libya's military chief of staff crashed in central Turkey, killing him and 7 others. The plane reported an electrical malfunction after takeoff and requested an emergency landing, but disappeared from radar during its descent, and contact could not be reestablished, according to the Turkish government. Libya declared 3 days of mourning and said it would dispatch a delegation to Ankara to coordinate with Turkish authorities who have opened an investigation into the incident. Meanwhile, the Trump administration imposed visa sanctions on former EU Commissioner Terry Breton and 4 other people for trying to make American tech companies police political speech on their platforms. The State Department targeted activists and nonprofits focused on digital hate speech and countering extremism. And shares of Nike are rising 2%. Filings show Apple CEO Tim Cook, who is also a Nike board member, has bought nearly $3 million of shares of the sporting goods maker. Nike, which plunged last week on disappointing earnings, is down about 24% this year. That's your Bloomberg Brief. Annmarie.
Thanks so much, Yahira, for bringing us that story. I did not know that Tim Cook was such a Nike wearer, apparently wearing one-of-a-kind Nikes around the world all the time.
Well, he's been a longtime board member of the company. I guess that's how he expresses his personality. You know how tech guys in the industry like to wear kind of fun socks,
uniform.
crazy socks? Yeah, they wear
But everything else
on
is
top.
uniform.
Yes, but they can express their personality, their whims through their socks and through their footwear.
It's sneakers or trainers for Tim Cook. It's like how Jonathan Ferro, his only expression is a tie. This is interesting. I'm now going through and seeing what kind of style Tim Cook has, just solely based on what sneakers
Air
he's
Max
deciding.
ones and custom stitched Vomeros. That's
Okay.
what he favors.
All right, I'm going to check them out. No hocus for him. Up next, calling for lower rates.
The Federal Reserve is too tight. I think it's our job to balance prices in the labor market, and I think that we are not doing a great job. If we don't adjust policy down, then I think that we do run risks of rising recessions.
Next up, Cameron Dawson still with us. We're going to get into what policy potentials could be on the horizon for 2026 that might impact financial markets. Thanks for joining us this morning, and Merry Christmas. Good morning. Welcome to Bloomberg Surveillance. Equities muted this morning as we head into the opening trade. It's going to be a shortened trading day, we should know, because it is Christmas Eve and you do have red and green on the screen. All the action once again in the commodity space. Gold is, at one point, it passed $4,500 an ounce. Silver also up 1.3%. But as Scarlett and I have been saying, this is so small compared to what we've seen for the entire year. Silver was up 150%. Under surveillance this morning, calling for lower rates.
The Federal Reserve is too tight. I think it's our job to balance prices in the labor market, and I think that we are not doing a great job. If we don't adjust policy down, then I think that we do run risks of rising recessions. The unemployment rate has poked up, potentially above where people thought it was going to go. And so we've had data that should push people into a dovish direction.
Here's the latest. President Trump ramping up pressure on the Fed, saying, quote, "I want my new Fed chairman to lower interest rates if the market is doing well." Bloomberg's Jonathan Tamari joins us now. Jonathan, this is a huge question mark for financial markets going into 2026. Who will be the president's choice for Fed chair? Give us a sense of where we are in the process.
Yeah, I mean, well, we thought at one point that we would already have an announcement by this time. This was the time frame right now that the administration had initially previewed for an announcement. Obviously, that's been pushed back. The president has kind of narrowed things down. We think Kevin Hassett is the name that I think a lot of people think is going to be his pick, his economic advisor, but he's obviously not the only person. You can see on screen some of the other folks, Kevin Warsh, Christopher Waller, who are also seen to be in the mix. I think what the key, though, is that whoever it is going to have to be somebody who's loyal to the president and is willing to make moves that support the president's agenda. It's just another way where the president is treating the federal government, the whole federal government, as something that he directs, and ending the independence of places, or hoping to end the independence of places like the Fed, the Department of Justice, that have typically operated separate from the president's political agenda.
Jonathan, I also want to get your take on what we learned last night. A federal judge saying the White House can move ahead with its plan to impose a $100,000 fee on new H-1B visa applications. We know this is something that the tech industry has been pushing back against because they certainly rely on this type of visa to hire skilled and educated foreign workers for very specialized roles. Is this something that they're going to let go of, or is there still a lot of perhaps campaigning behind the scenes for exceptions to this?
Yeah, I mean, I think there is still going to be campaigning against this. It's obviously a big win for the president and his push to really curtail immigration. legal immigration and illegal immigration, both. But the U.S. Chamber of Commerce still has a chance to appeal this. There are still lawsuits coming from some state attorneys general who say that this is going to affect services for healthcare, for education. So this fight is not over yet, but it's certainly a significant win for the president for now, and going to be a significant burden on these tech companies. You're going to see these H-1B visas go from a few $1,000s a piece to $100,000 a piece. And we'll see if they're willing to pay that to keep bringing in, high-skilled workers from overseas.
Huge debate for the Republican Party ahead of the midterm elections. Jonathan Tamari, thank you so much for joining us this morning. Merry Christmas to you and your family. Scarlett, I do remember, though, on the campaign trail, the president talked about if you are graduating from a college, you should be given with your diploma a green card to stay in the United States. And he seems to be being pushed and pulled in different directions based on where the Republican Party is moving on this issue.
Yeah, that's a good point. But I suppose he could say he is consistent with that idea. He just wants companies to pay up for that privilege, right? He's not saying you can't do it. He's saying pay $100,000 before we get started.
True. All right, Cameron Dawson of New Edge Wealth is still with us. Cameron, let's look at what some of the policy uncertainty may bring for next year. I remember this year, everything was about tariffs. We saw the lows of the financial markets after Liberation Day in April. When it comes to next year, what are the biggest risks when it comes from the uncertainty out of the Trump administration?
I think it's a big question of what we get out of the Fed and how much influence the Trump administration is going to be able to have on the Fed. I think that 2026 is going to be the year of the debate or the quest for neutral, where you've heard from folks like Myron as well as Bessent talking about that they think the neutral rate should be far lower than it is today. But you're also hearing from folks like Powell saying that we are effectively at neutral. And the interesting paradox of all of this is that they could both be right. It just depends on where you're looking. If you're arguing that we are already at neutral and policy is already kind of easy enough, you would look at financial conditions being at the easiest levels that we've had since 2022. You look at this last third quarter GDP print, that nominal GDP came in at 8.2%. That doesn't seem like an economy that's gasping for rate cuts. But if you argue that neutral is actually far lower than it is today, you look at the unemployment rate ticking up. You look at the Conference Board labor market differential looking absolutely ugly yesterday. So maybe the lesson is that neutral is in the eye of the beholder, but all of this does is creates a cloud of uncertainty about what the Fed's next move is going to be.
Well, when it comes to the eye of the beholder being the president of the United States, we are definitely far from neutral where he wants to see interest rates. How are you thinking about the Fed race for the chairmanship, especially given the fact that the president has really taken his time? I was told in April by the Treasury Secretary we'd have a decision by the early fall.
Yeah, I think it's a question of how do you get somebody in that Fed chair seat that is also going to be able to have influence over the other members of the Fed, meaning that it's not just one person's vote that counts, it's the entire board's vote that counts. And so the question is, can you thread that needle? Can you put somebody into the Fed that will argue and push for much lower rates and also get the rest of the voting members to be able to coalesce behind you? And so it really is that question of finding that right personality. Maybe it's somebody who needs to be an insider, having had experience at the Fed versus an outsider. That could be one of the reasons why we've seen this bit of delay. But it really is a matter of being able to have somebody that will, one, support the policies that you want, but two, get others to do it as well.
How do you get the bond market on your side? Because there were some concerns about Kevin Hassett that he would struggle to deliver all the rate cuts Trump wants because the bond market was not convinced that he was sufficiently independent. And we know the president has made clear he wants lower rates when the economy, when the market, when the data shows the economy is doing well. That puts whoever's going to be Fed chair in a difficult position to deliver that and also maintain credibility.
Yeah, I think it was the Rolling Stones that you may not always get what you want, but you get what you need. You might want lower rates and a strong economy, but that's typically not how it works. Meaning that if you go back to that 2024 period where the Fed delivered 100 basis points of rate cuts and you saw the long end of the Treasury curve go up by 100 basis points, that was because you were seeing economic surprises shoot up meaningfully and you were seeing revisions higher to GDP. All of this is a lesson in the fact fact that the 10-year Treasury yield and longer end rates will be sensitive to things like economic surprises. So if you are in an environment where the economy is humming along and you are seeing upside surprises to growth, and you are cutting interest rates, it's very likely that you will see the back end of the curve move higher. So it might be that you want both of those things, but they typically don't happen at the same time unless we see them pursue some kind of policy that looks like yield curve control or quantitative easing.
Right. So to that end, what other policies might you expect or might you anticipate the White House to take in order to keep long-term rates lower?
Well, we think that you could see a rebrand of quantitative easing into something that looks like quantitative freedom in order to be able to justify going down the path of pushing long-term rates lower. Because we do know that they want the long end of the yield curve, and really everybody wants the long end of the yield curve to be lower in order to support the housing market. The housing market continues to be in the doldrums. It hasn't had the same kind of broad impact on the overall economy as it has had in prior cycles because of labor shortages. You actually still have record people employed in the housing related construction sector this cycle, which just means that even though housing has been so weak, it hasn't metastasized to the rest of the economy. So I think the big question is, what can they do to get those cyclical sectors that are sensitive to long end yields to move higher in 2026? And does that include potentially controlling the long end of the yield curve?
Cameron, what do you make of the administration talking about potentially $2,000 tariff dividend checks going out to Americans? Will this goose inflation?
Yeah, well, we certainly learned that story back in 2020 and 2021 with stimulus checks. I think the important caveat to that is one of the reasons why those checks were so very inflationary is because not only were you giving people money to spend, you were also removing the ability to be able to spend on other things, meaning because you had so many supply chain disruptions and shutdowns related to COVID, all of that created was this sort of inflationary boom. But given the fact that you're still in an environment, as I mentioned earlier, with very easy financial conditions, you already are running 6.5% deficit to GDP. All of that suggests that easy monetary policy, already easy fiscal policy, and then super juiced, super easy fiscal policy, any kind of Econ 101 textbook would suggest that that would be inflationary, and to suggest that maybe the bond market, who still has a very sanguine view of longer term inflation, five-year forward break-evens are just at 2.44%, maybe that kind of optimism about inflation is misguided.
Cameron, thanks so much for joining us this Christmas Eve morning. Merry Christmas to you and your family. Cameron Dawson of New Edge Wealth. You know, Scarlett, as she's talking, I'm thinking, but it's an election year.
That's right. That's where my head was going as well. So, of course, they're going to, even if they don't do it, just floating the idea gets that idea out there.
Although it's very circular. Put tariffs up 2025, take that money, say it's being used to the deficit, but then dole it out as checks.
Yeah.
Feels like it's the same kind of money just circulating.
Well, you know, for those who aren't on top of every news point, it might work.
All right, coming up, Yahira with your morning movers. Nike shares getting a boost from Apple's Tim Cook. You're watching Bloomberg Surveillance. Good morning and welcome to Bloomberg Surveillance and Merry Christmas. I'm Annmarie Hordern alongside Scarlett Fu today. Jonathan is still on paternity leave and Lisa is off for the week. Lisa will be back with you next week. She'll be guiding you into 2026 and the gang is back together in the new year. Where we are this morning is equity futures pulling back just ever so slightly. Come on, there's no drama. It's unchanged. This comes after the S&P 500 hit a 38 record high for 2025 yesterday. Gold, silver, all trending higher alongside the entire commodity complex as well when you look at other things like copper especially and platinum as well. And a lot of people are saying this is going to continue into next year. Idiosyncratic issues. Copper, maybe it's tariffs, maybe it's supply issue. Gold, central banks are buying. Silver, poor man's gold, maybe it's a place for store value. And it's a place for the physical economy. Lots of different stories, but the commodity complex is definitely trending higher. And then to Scarlett's point, she said this is the currency we need to be talking about this morning, the won. South Korea's won strengthened after the authorities there said excessive weakness in the currency isn't desirable. So some verbal intervention.
And they're also saying that the markets will soon see the government's strong determination. And I point this out because this is a big move in the currency market, a 2% move where the dollar is gaining versus the won, the dollar is falling, and there's the line down versus the Korean won. And not that the Korean won is a huge weight in the Bloomberg Dollar Index, but it does kind of matter. And this is partly why you're seeing some weakness in the U.S. dollar. On the whole, though, the moves against the other currencies are pretty negligible.
Right. It's Christmas Eve. Low volume. 2 hours away from the cash open. Here's your morning movers with Yahira. Hey, Yahira.
Hi, Annmarie. We start with some M&A news with Dynavax soaring 38% in the pre-market after French drug maker Sanofi agreed to buy the company in a more than $2 billion deal to expand its vaccine portfolio. But the most fascinating part about this deal was the timing, because the statement came just minutes after U.S. regulators delivered a blow to Sanofi by surprisingly rejecting its treatment for MS. Meanwhile, Nike shares getting a boost on a vote of confidence from Apple CEO Tim Cook. Shares are up 2% because not only is he buying their shoes, as you guys have been talking about all morning, he's also buying Nike stock. He bought nearly $3 million worth of shares after the stock plummeted due to those disappointing earnings last week. But the big question is whether 2026 will finally be the turnaround year for Nike, and Apple CEO Tim Cook seems to think so, and he is also on the board. I forgot to mention that. And we end on UiPath. This is a company that provides automation software to allow workers to do other creative tasks. Well, it's getting a boost up 8% on news that it's joining the S&P Midcap 400, which of course triggers automatic buying from index tracking funds. But it's another boost for a stock riding optimism that it will emerge as a winner in the AI boom, with shares already up nearly 25% year to date. Annmarie?
Thanks so much, Yahira. On our radar this morning, a federal judge upholding President Trump's $100,000 fee on H-1B visa applications, the ruling boosting the administration's campaign to push demand for U.S. workers. But Scarlett, I have to say, I think this debate and this story is going to continue into next year. Chamber of Commerce pretty swiftly came out and said they're disappointed with the court's decision.
Right, and they can always appeal the ruling. And of course, the tech companies will continue to lobby, I think, in the background for some kind of give on this.
Absolutely. When it comes to Amazon, Meta, Tesla, these kind of companies are going to be behind the scenes, probably talking to the White House about potentially how much cost this is going to be for their bottom line, because they do need some of these workers. All right, the dollar heading for its worst annual performance in 8 years, down about 8% in 2025. I mean, obviously, look where gold is. You can see where the dollar's going. Traders preparing for more downside ahead with expectations of rate cuts weighing on the greenback. And influencer and WWE wrestler Logan Paul is set to sell the most expensive Pokemon trading card at auction.
Let's be honest, the Pokemon market is as hot as it's ever been right now. And those people who thought I was an idiot, I think I'm the one laughing in their face now, because Pokemon has delivered higher returns than the stock market in the past 20 years.
All right, well, he got me because I did literally just laugh out loud. Paul bought the card for over $5 million in 2021, with the collectible now estimated to sell between $7 million and $12 million when it's auctioned on January 12th. Scarlett, I had no idea Pokemon was still a thing, except for my nephews, but they're 9, 7, and 4.
Well, you know, Logan Paul and people from his age group were probably collecting Pokemon cards when they were younger. Yes, that's right. And now there's an opportunity to trade, and there's some liquidity in this market. And, you know, we know the financialization of everything is taking place. So this just extends to your trading cards.
Do you think I can get money for those Beanie Babies I was buying?
Do they still have tags on them?
Yes.
Okay, well then, yes, I think so.
I have boxes of them.
Well,
all right,
there
Logan
you go.
Paul, give me a call. Tomorrow
Price
morning.
discovery.
And tomorrow morning, kids around the world will be opening millions of toys, including Barbie dolls and Hot Wheels. David Rubenstein sat down with the CEO of the company behind those iconic brands.
Now, the toy world is not a world that I know that well. I do have some young grandchildren and get them some toys from time to time, but I don't really pay attention to where the toys are manufactured. My assumption is that most toys in the United States are actually manufactured overseas, and maybe a large number of those in China. Is that a fair assumption?
That's correct. The industry average is about 80 to 85% of toys being made in China. For Mattel, we've been reducing and rebalancing our manufacturing footprint so that no one country by the end of 27 will represent more than 25% of our global manufacturing. China represents for us today around 35% of our global manufacturing relative to industry average of 80 to 85%. But this journey was not about China. It was about balancing and diversifying our manufacturing footprint so that we're not dependent on any one country.
As we talk today, President Trump is shortly going to be meeting with President Xi Jinping, presumably to deal with tariffs and other things. But to date, the tariffs that have been imposed on China, has it adversely affected toy companies and particularly Mattel?
Well, at the start of the year, the issue was about cost impact of tariff on product. Then the question became, what about consumer reaction to price increase in response to tariff? Now what we're seeing is that companies have mitigated for the cost impact. Consumer demand for toys is growing, has been growing every quarter in the US and overseas. What we have seen is that retailers have postponed their decision in making orders to the very back end of the year. But seeing that there is demand, there is consumer demand, people are buying product at retailers, we expect to see a good holiday season and a strong growth quarter for Mattel.
Now, about 50% of tariffs that have been imposed by the federal government have not been passed along to customers. They're being absorbed by the people that are paying the tariffs. Are you absorbing a large part of the tariffs, or are you passing along some of it?
Well, we have several mitigating actions that we're taking. Much of it is about diversifying our manufacturing footprint and using the fact that we are making product in 7 different countries, so you can optimize and modulate and create a flexible model that responds to tariff and shifting market conditions. And this is very much part of our journey to create a flexible supply chain that is responsive.
As the tariffs have now come in, and to some extent there might be increased, there might be decreased, but how has that changed your relationship with retailers? Are they absorbing the tariffs, or are you absorbing the tariffs, or is it split?
We work very closely with our retail partners. We are fundamentally a business-to-business company. We sell to the retailers, they sell to the consumers. But together, we are trying to create a holistic experience that drives demand, and we work with them to help them sell products. We spend significant resources on demand creation. We sell product as a company in 500,000 stores globally. This is just a brick and mortar business, not including online retail and e-commerce. So understanding the retail landscape and working in close collaboration with our retail partners is core competence to what we do. And we do that really well.
So as people are getting ready to buy toys for Christmas season, what do you want them to know the most about what they should be buying in the toy world?
You know, we are so proud of what we do. Every Christmas we create product that we believe stands out in a very crowded aisle, the toy aisle. And our job is to continue to do things that will excite and delight fans and partner with our retailers to create an offering that will be very compelling. Of course, it's always about Barbie, Hot Wheels, American Girl, Fisher-Price, Uno, Monster High, endless collection across multiple price points. You can buy a Hot Wheels die-cast car for $1.25, or you can buy a collector set that we did together with Daniel Arsham, a famous artist, for $700 on Mattel Creation.
And when you're dealing with Christmas, you have to figure out, do you get new toys designed so that that's something different, or you get old reliable toys that you know the parent is going to say, yes, this kid will like it because it's been around for a while?
It's a combination of both, and it's art and science. There's no playbook, and there's no predictable pattern that you try to follow. In many ways, you invent and you create product and create the demand. But what we are seeing in a world of unlimited shelf space and ubiquitous distribution, the big brands win. The big brands that have the awareness and built-in fan base always have the advantage.
That was David Rubenstein with the Mattel CEO. Let's get you an update on other stories we're watching this morning. Yahira's back with your Bloomberg Brief. Hey, Yahira.
Hi, Annmarie. Gold is continuing to rally into year-end. The precious metal trading above $4,500 an ounce for the first time ever earlier. Gold is up more than 70% this year, and silver has risen by nearly 150%. They are on track for their best annual performance since 1979. Meanwhile, in sports, Brooks Koepka is the first player to defect from Saudi-backed Live Golf. The five-time major champion is leaving to spend more time with his family. The PGA suspends players who take part in the Live Tour. Non-members are banned for a year from the date of their last Live outing. And ServiceNow announcing it will buy cybersecurity startup Armis for $7.75 billion. It will be the company's largest acquisition to date. ServiceNow is looking to use Armis's technology to help clients fend off cyber attacks. That's your Bloomberg Brief. Annmarie.
Thanks so much, Yahira. Up next, resetting global trade.
President Trump, the administration, has essentially reset the global trading order to move from total liberal trade in the United States without any cost to a new, fair, and balanced approach. It would be terrible if the Supreme Court overturned the case.
Joyce Adetutu of Vincent and Elkins joins us next. You're watching Bloomberg Surveillance. Good morning and welcome to Bloomberg Surveillance, and Merry Christmas if you are joining us this morning. Equity markets are pointing to potentially, we're muted, but we're at an all-time high. So all good news.
Unchanged.
Unchanged, yeah. And basically we're getting that Santa Claus rally that everyone was hoping for. Very low volumes today. Gold and silver, as we've been saying all morning, as we've been saying all week, they continue to shine. Gold is up 50%, 70% on the year, and silver 150%. Under surveillance this morning, something to be mindful for next year, resetting global trade.
President Trump, the administration, has essentially reset the global trading order to move from total liberal trade in the United States without any cost to a new, fair, and balanced approach. It would be terrible if the Supreme Court overturned the case because we have built a new global trading order on the back of these tariffs. We will do whatever we need to do to make sure that we can maintain the tariffs we need.
Here's the latest. The Supreme Court weighing a legal challenge to President Trump's tariffs. If scrapped, the government could owe the bulk of the $165 billion from collected custom duties. Joyce Adetutu of Vincent and Elkins writing, quote, refunding the tariffs won't be as simple as pressing a button. Custom and border protection faces a massive administrative lift involving protests, liquidation issues, and multiple court processes. Joyce joins us now. Joyce, before we get into how much of a mess that might be, and that's actually one of the reasons why the administration is telling the Supreme Court they cannot undo IEEPA, what do you think the court will ultimately decide?
It is interesting and a good question. Thank you guys for having me here. It's a pleasure to be here. I think ultimately the court is going to come down on the side of the tariffs are not constitutional under IEEPA. The major question in the case is whether the International Emergency Powers Act allows the president to, under the authority to regulate imports, to impose this tariff. And it has historically been a power that is left to Congress. And frankly, I think the Supreme Court is going to agree that the Trump administration took this one step too far when it determined that regulate imports means that you can impose tariffs broadly across the globe.
What if the Supreme Court does end up saying IEEPA was illegal? When it comes to the refunds, what's the first start of that process?
So, unfortunately, there's not really a set way to refund these tariffs, given how big the amount of money is. So the first step, I think, is going to be the court making the decision to say these are unconstitutional. And then it's going to be a question of how the Court of International Trade and CBP ultimately decide to do the refund process. Right now, the presently existing structure would be Either you file what's basically a correction to your entry summary if your tariff entries haven't liquidated. That's basically the process for truing up how much you paid on the date of entry. Or you would have to, if your entry has liquidated, go ahead and file a protest and protest that liquidation, saying we paid too much and now we expect a refund back. And that's quite an administrative burden.
What happened to the payments that companies had made for the tariffs? I mean, I know that they ended up at the Treasury, but are they sitting somewhere specifically at the Treasury where it's accessible?
I highly doubt it. How this is usually run is those funds are paid, they go into the big revenue pot, and they're used for other things. And this country has to run on some level of revenue, and this is a lot of revenue. There's a lot going on. So it's not like dollar for dollar, this is sitting in an account waiting for someone to refund it and push a button.
In terms of companies that have filed suit and are looking for refunds should the Supreme Court rule against the White House, what are the details that they need to be on top of? What are going to be the key things that a decision will revolve around?
So I think ultimately, if this goes all the way through the process of issuing refunds to everyone, I think documentation is going to be critical. One of the major questions is going to be, what rate did you pay on date of entry, and was that the correct rate? This has been a very volatile tariff strategy. There's been a lot of changes in the tariff landscape, and on one day, you may have been subject to a 10% tariff, and the next day a 50% tariff, and the day after that subject to a tariff based on a trade agreement between the two countries. So the question is going to be, how well have you documented all of your payments and all of the information so that when you go through that protest process, you are able to confidently say, I'm entitled to this refund and here's why.
Okay, so let's call it tariff yo-yo. If we do have the Supreme Court striking down IEEPA and the administration uses other avenues, 232s, 301s, other sections to enact those tariffs, if you're a company, do you go get refunds for the IEEPA, or do you just wait it out because you're going to be paying tariffs just under a different legal avenue in the months to come?
So there are some companies that are really, really pushing for, instead of a refund, a credit against future tariffs, which is an interesting and sophisticated approach. I think for some, that works incredibly well to say, hey, you don't have to refund this. We recognize dollar for dollar, these dollars may not exist, but give us a credit. For other companies where they don't import as often, those dollars mean a lot more right now, and that's very difficult to just sit and wait for a potential future import that may never come. So I think it is possible that some may say, I prefer the credit, but others may really want to go through that process and really seek to get the refund that they're entitled to.
Absolutely fascinating. It's going to keep us all busy in 2026. Joyce, thank you so much for joining us, and Merry Christmas to you and your family. Joyce Adatutu of Vincent and Elkins. Bloomberg did a deep dive on the president's tariffs, and when he rolled them out in April, economists braced for the worst. Since then, a lot has happened, but the sky has yet to fall. Were the experts wrong, or is it too early to tell? Take a look.
Credit where credit's due, President Trump made a big bet that the US had a magnetic appeal, and that would enable him to get a better deal from US trade partners and companies that want to do business in the United States. On the evidence of the last few months, that bet is playing out pretty nicely. Economists don't agree on much. One thing they do agree on is that free trade is good and that tariffs are bad. For a moment, Trump escalated US tariffs on China all the way to 125%. If you plugged the US tariffs into a model of the global economy, what it said was that there was going to be a really significant drag on growth, and there was also going to be a significant upward impulse to prices. But when we look at what's happened to inflation over the summer, it's not come down, but it's not come up either. Why is that? It's because US importers and foreign exporters saw the Trump tariffs coming, and they rushed to front load, shipping to the United States before the tariffs could come into force, One thing that's happened is that we've gone from a lot of unexpected bad news concentrated on a single day to a series of country-by-country deals. They're something of a Swiss cheese of exemptions and carve-outs. The trade war is a drag, but it's not the only thing which is happening. We've got tax cuts with Trump's One Big Beautiful Bill, and we've got a bonfire of regulations which is stoking the animal spirits of US businesses. We've also got the artificial intelligence boom and a huge amount of investment going into data centers. Tariffs are having an effect. China's exports to the United States are way down relative to the historical trend. So, who pays for the cost of tariffs? Despite his well-known love of gold, the president is not an alchemist. He can't make something from nothing. That money has to come from somewhere. All of the evidence so far suggests that in the end, the bulk of it is going to come from US businesses and US households.
Going to be a huge story in 2026 as it was in 2025. Maybe we are past peak uncertainty, but when it comes to potentially these refunds, that is going to be a headache to say the least for corporate America. Also for corporate America this morning, Intel, maybe a headache as well for the U.S. government that has a stake in this company. There is a report from Reuters that Intel right now, or Nvidia rather, is halting a test to use Intel's production process to make advanced chips. Basically meaning they still need to use the chip manufacturers in Taiwan.
Right. And of course, this was kind of one of the things that Intel was counting on, and that shareholders of Intel were certainly counting on to make the company more relevant. And it's not just Nvidia either. Broadcom as well was also reportedly testing whether it would make its chips using this 18A production process. We don't have any word on whether Broadcom is going through with that or not, but Reuters saying that Nvidia has stepped away from those plans. This is not great news for the stock of Intel.
Not great news for the stock of Intel. Not great news for this administration, which took an equity stake in Intel, really viewed this as a make or break moment. The Treasury Secretary this week was on the All In podcast talking about the fact that 97% of our chips are manufactured in Taiwan, and they can't have that sort of dependency and reliability. The issue is when you have customers like Nvidia saying, well, actually, we don't want to use your processing.
Well, and it's not to say that it won't happen in the future, but perhaps right now is not the time, because it was a quick turnaround to get from we're testing it out into we're definitely doing it.
All right, more on this story coming up next. Plus, Bob Elliott of Unlimited Funds, Stephanie Roth of Wolfe Research, and Anisha Sherman of Bernstein. You're watching Bloomberg Surveillance on this Christmas Eve. Thank you for spending your holiday with us if you're up and watching. The global backdrop is healthy.
There are winners and losers that people are picking right now.
Underneath the surface, there is both tech and non-tech parts of the market that is driving that charge higher.
As an investor, you need to be on your toes and be ready for surprises.
There's definitely some dry powder coming for next year.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Good morning and Merry Christmas to you and your loved ones. I'm Annmarie Hordern alongside Scarlett Fu this morning. Jonathan Ferro is still on paternity leave and Lisa Abramowicz is off this week for the holiday. We do want to get to some breaking news. This is coming from Reuters, but it's definitely moving the share price of Intel this morning. Intel shares now unchanged. They were down, though, as much as 4% at one point. This comes to the fact that there is a report that Nvidia has halted a test to use Intel's production process to make advanced chips. The issue why this is so important, Scarlett, is because everyone was viewing this as really a make or break moment for Intel.
Right, absolutely. Intel had this technology that no one really else had, and we know that Intel and the U.S. government, which is a shareholder in Intel, really want to reclaim American leadership in chip making. And so this push to make advanced chips inside the U.S. is an attempt to really challenge TSMC as the preeminent chip maker of the world. It's not just Nvidia. Broadcom reportedly also testing whether it would use this production process that Intel has come up with. We don't know whether Broadcom is moving forward. And for Nvidia, I guess the question is this merely a pause or is this an actual decision to to move away from Intel.
Yeah, we're going to have to wait for Jensen Huang to weigh in on this part of the story. What I find interesting about this is the administration's entire approach to taking equity stakes. What really is state capitalism? They are picking winners and losers, and they wanted to pick Intel as a winner.
They wanted to pick Intel as a winner, but I suppose they could argue that the previous administration had already done that through the CHIPS Act by giving Intel these big grants. So they're kind of following through on what had already begun.
But what's going to happen? Because the Treasury Secretary this week spoke to the All In podcast, and when he was asked about this idea of state capitalism, he was saying how we're in an economic war. And the U.S. needs to make sure they're going after critical industries.
Well, I mean, in many ways, the U.S. is doing what other countries have done, creating national champions. And Intel, unfortunately, has been behind the curve when it comes to these advanced chips. It really missed the boat on a lot of it, and it's making up for some lost time. And I don't know how much time you can make up when the chip maker, the company, the management has not been focused on those advanced chips. Let's just show you what's happening across markets right now. Financial markets. Again, the day before Christmas, you're not going to see a whole lot of movement, and there you have it. S&P futures, little changed at the moment. Of course, this comes after the S&P 500 closed at a record high yesterday, and in fact, the MSCI All Country World Index also at a record high as well. So big gains for equities, not just in the U.S. this year. Not much movement in the rate space. The 10-year yield unchanged at 4.16%, but the big moves really are in commodities, the metals, gold, silver, copper, platinum, what have you. They're all climbing. And in the case of gold and silver, record highs for these precious metals. But it's not just the precious metal aspect that's attracting a lot of investors. The industrial metals, and silver plays into that, copper as well, Annmarie, really getting a lot of attention here because of the build out of the AI infrastructure, as well as the build out of the green energy world outside the U.S.
Yeah, it's a great point. Outside the U.S., this massive buildup. Coming on the program, Bob Elliott of Unlimited Funds as investors bet on a strong finish.
Stephanie Roth of Wolf Research as we parse through fresh labor data, and Anisha Sherman of Bernstein as retailers brace for Christmas.
We begin this hour with futures on hold, looking for a fifth straight of gains. Bob Elliott of Unlimited Funds says stock and bond markets are sure of a strong growth, limited risk, and low volatility. Bob joins us now.
Bob, thank you so much for joining us today. So when it comes to what you're seeing for 2026, how does the setup, how does the way we're ending 2025 position us for your anticipated outlook for 2026?
Well, I think the U.S. economy in particular faces a real fork in the road as we enter 2026. The core of the economy has slowed down considerably in the second half of the year, and particularly since September. And without a significant amount of federal government or Fed intervention, it's probably going to be much weaker than what's currently priced into things like stocks. At the same time, essentially the only way for the Fed and the Treasury and the federal government to stimulate the economy is through this sort of persistent debasement approach. And so the fork in the road is, does the administration and does the Fed accept weak growth or continued relatively significant debasement that we're seeing across a variety of different areas like metals and the dollar?
Right. So talk a little bit about that debasement, because it was a big thing earlier this year, and it's kind of fallen off a little bit. And part of that might be because crypto is not taking part in it. When you see gold prices and silver prices rally, but crypto is not along for the ride, it feels like it becomes something else. How has the debasement trade changed from a few months ago to what it is now, and what you see it being in 2026?
Well, I think in a lot of ways, earlier in the year, people got confused about what was a shift to an easier Fed policy, a pivot to focus primarily on labor markets, which lifted all financial assets. Every financial asset under the sun in the third quarter basically was up. That's very different from a pure debasement trade, which is that you have a situation where the administration and the Fed need to ease materially even to get moderately good growth. And so that's why we've seen a real shift here away from essentially the riskiest asset of the major assets, which is in Bitcoin and the variety of crypto areas. And we've seen a shift towards sort of more pure debasement plays like gold and silver to some extent. And the reality is they may call Bitcoin digital gold, but it is not gold. And it's once again showing that through the end of the year.
You know, the president has been saying that he wants the good news is good news dynamic back in markets. When the economy is doing well, he wants the Fed to lower rates. He doesn't quite get on board with the whole idea that good news is bad news, that when there's good economic data, people get worried about inflationary impulses and they worry about potential rate hikes sending stock prices lower. What you're saying, though, is that the core of the U.S. economy is weak and decelerating, and if that leads to a rate cut, that's not exactly what the president has in mind. Can he get both what he wants and lower rates?
Well, it's possible that he gets lower rates and that is supportive to the economy, or more expansionary fiscal policy, which is supportive to the economy. There's just a trade-off here, which is pursuing those policies will be significantly dollar negative, as well as bullish for things like gold and silver. Like, we've gotten stocks are up, in the mid-teens this year, and that's a pretty good year, all things considered. But remember how much debasement it has taken to get to that point. Right? Gold's up 70%, silver's up 150%, as you've been talking about. Think about how extreme those moves are in those assets just to get what is a bit better than average outcome in the equity market, and a real economy that looks extremely soft at this point ending the year.
So let's talk about the fragility in technology, because your take here, and this is out of consensus, is that the maximum benefit from the AI investment boom is behind us. So what have we seen in the end then?
Well, I think in some ways it sounds like a very out of consensus view, but it's a data-driven view. And actually, yesterday's GDP report, I think, was instructive. There wasn't a whole lot of new information, but one area where there was information, incremental information, was around the spending on software, as well as investment in the sort of core infrastructure related to AI. And what we've seen is, while that boomed early in the year and added almost 1.5% of GDP growth for the first quarter, that has trailed off in the last couple of quarters. And what we're seeing today in the third quarter and likely here in the fourth quarter is that AI-related CapEx and investment is adding maybe a few tenths of a percent of GDP growth, but that is not a meaningful driver of the economy. It really comes down to the consumer, and the consumer is facing significant headwinds as we wrap up the year. Labor growth is zero, wage growth is compressing significantly, inflation is up. That is not a good combination for spending, for household spending in the new year.
But there's no spending. I know we had consumer sentiment yesterday, and good morning, Bob. Sorry, I had to get some water. I know we had consumer sentiment yesterday falling for a fifth straight month, but MasterCard Spending Plus found that consumers' retail spending, excluding cars, increased 3.9% going into the end of the year. The consumer is still resilient, is it not?
Well, I think there's a range of different timely estimates, and MasterCard Spending Pulse is just one of them, and probably the most positive of the various measures, which is why it's getting a lot of attention. If you look at other measures like the Bank of America spending data, it's showing zero growth in November and December. Of course, that's the retail sales numbers have shown zero growth at a headline number the last couple of months that they've been reported. And Chase card spending is actually showing overall spending growth overall spending in this season is actually lower than it was in 2024. You add that to, weak TSA numbers and open table numbers rolling off. And I think the preponderance of evidence here is that the consumer is not nearly as euphoric in this holiday season as they were in previous ones.
Bob, do you see a recession potentially on the horizon?
Well, I think we really are on a knife's edge. And this is the challenge with the administration's policies that have been significantly growth negative, both in tariffs and in constricting immigration. Two policies that will likely persist in the new year. And so that really creates this environment where it doesn't take a whole heck of a lot to start to cause households to really retrench their spending. I mean, it's really been supported by asset prices continuing to rise. And it's interesting to see, even in this last couple of months where stock prices have basically traded flat, even though they've touched new highs, we've seen this consumer retrenchment in demand. And so that really goes to the essence of the point, which is either the administration and the Fed have to pump asset prices to keep getting spending that's outpacing income growth, or they're going to face a challenging set of economic conditions ahead, which have the risk of tilting to being a more self-reinforcing negative dynamic. we have to remember the unemployment rate continues to rise. And the labor markets are very weak here. And it doesn't take a whole heck of a lot for that to, that weak hiring environment to then translate into actually a layoff environment. And that's when, things get very risky.
Right. So given this outlook, Bob, how do you want to be allocating your funds?
Well, I think you've got to look at areas where this sort of trade-off is not necessarily well priced. And so if you look at, which path they might take. If you look over on the probable debasement path, it is notable that short-term interest rates, say 2-year interest rates or what's priced into the Fed, is only 1 or 2 more cuts ahead. And that really is not that much easing of monetary policy, certainly relative to the president's rhetoric about what he's looking for in a new Fed chair. And so that's an interesting opportunity to go long those rates, expecting easier policy than currently priced in. On the debasement side of things, or on the weak growth side of things, there's, obviously stocks can continue to run as a result of this AI-related boom, and you don't necessarily want to get ahead of that. And so there, it looks like more of the interesting opportunity is to some extent in the precious metals, though they're up a fair amount. It's really in volatility, right? I mean, volatility across all financial markets is extremely low. If you look at basically all expectations, they're for, a pretty good year, tightly distributed. And the smallest cracks in that, with asset prices at all-time highs, is likely to create much more substantial volatility than currently priced into the market.
Bob, thanks so much for joining us this morning. And Merry Christmas to you, Bob Elliott of Unlimited Funds. Let's get you an update on stories we're watching elsewhere. Here's Yahira. Hey, Yahira.
Hi, Annmarie. Intel shares are falling 2.3% on reports that Nvidia is pumping the brakes on tests that used Intel's technology. Reuters reporting that Nvidia stopped moving forward with Intel's 18A production process for chips. It follows an agreement back in September where Nvidia agreed to invest $5 billion in Intel and co-develop chips. Meanwhile, President Donald Trump continuing to attack the Federal Reserve, calling for the central bank to cut rates. Trump posting on Truth Social that the next Fed chair should ease policy if the market is doing well, writing, quote, "Anybody that disagrees with me will never be the Fed chairman." The president is set to interview the final 4 candidates at Mar-a-Lago next week. And Commerce Secretary Howard Lutnick indicated that the rise in U.S. economic growth should have a direct correlation to Americans' wallets. Speaking on Fox News, Lutnick was reacting to yesterday's GDP print that showed a rise of 4.3% growth in the third quarter. He said Americans will now earn 4.3% more money that should make for a great Christmas. In reality, of course, the number does not tie directly to individual wages and salaries, unfortunately. That's your Bloomberg Brief. Annmarie?
Thanks so much, Yahira. Yeah, this statistically is just wrong. Just because GDP is up 4.3% does not mean that your paycheck will rise 4.3%.
It would be nice.
The direct quote from Howard Lutnick, what that means that Americans overall, all of us, are going to earn 4.3% more money. If he's going out and saying this, Americans are not going to be feeling this.
I don't think anyone else in the administration will be saying this because that's clearly not how things work. And I'm glad Yahira included that disclosure.
Yeah, time to tell. Let's see how they're going to pitch this one in the next year. Up next on the program, the morning calls, plus Bank of America Chairman and CEO Brian Moynihan on the growth of AI. That's next. You're watching Bloomberg Surveillance.
If we don't adjust policy down, then I think that we do run risks of rising recession. The unemployment rate has poked up, potentially above where people thought it was going to go. And so we've had data that should push people into a dovish direction.
That was Fed Governor Stephen Miron on the program joining us earlier this week. What's so interesting, Scarlett, is he might actually be going back to CEA.
Yeah, well, I mean, his term expires at the end of February, so he's gone unless they find a way to keep him and also get someone dovish as the next Fed chair.
Time now, let's call it, I believe, for our morning calls this morning.
Yes, let's take a look. First up, we've got Mizuho lowering its price target on Gemini to $26, noting softening crypto trading activity. Let's move on to Truist, which is downgrading its price target on Americold Realty Trust, there we go, to $16. And it's citing near-term supply and demand pressures. And finally, Raymond James is downgrading KB Home, the home builder, to market perform. Why? It's highlighting disappointing fourth quarter results. That stock down about 0.7% in the pre-market. So we'll keep an eye on those names on this Christmas Eve. But we want to turn now to artificial intelligence. Bank of America Chair and CEO Brian Moynihan telling Wall Street Week's David Weston that AI is starting to have a big impact on the U.S. economy.
The AI investment's been building during the year and is probably a bigger contributor next year and the years beyond. And so if you look at the data center build out, which is one of the ways it evidences itself, that's a big deal. If you look at client spending, like us spending on AI, that's higher than it was last year. But frankly, overall spending levels are shifting towards that, not necessarily growing at a mid-single digit rate type of number. So I think that's part why the reason we feel constructive for next year. We think AI spending continues. We think there's benefits to the American taxpayer from tax rebates, lower taxes due to the tax bill going through and being effective for next year. And we think the expensing and other bonuses for businesses are good. So all that leads to our confidence that we go from basically a 2% type of growth level this year, plus or minus up to 2.4%, which is all due to that. And AI is kicking in more and more. And so it's not all attributable to AI, but that's having a marginal impact that's pretty strong.
So much of the American economy is supported by the consumer. And you at Bank of America have a really powerful viewpoint into the American consumer. How's the American consumer doing? Because it has been very strong. There have been some people saying it's starting to slow down.
You have to step back. We look at American consumers, 70 million consumers, putting $4.5 trillion plus into the American economy every year. And we've tracked the way that goes in the American economy for many years. And so in the third quarter, it was up about 5% over last year. As we look at the fourth quarter here so far in October, November, I'd say it in a 4.5%, which is very consistent with a very solid growing economy. In the end of the day, it's going to work against wage growth. And we see in the underlying consumers we have wage growth, i.e. their paychecks are going up. And so the labor market's flattened out a little bit in terms of job growth and things like that. It's normalizing in terms of unemployment, but you still see underlying wage growth. So the American consumer spending at 4% more November this year versus November last year is a very solid backdrop. The credit quality of the American consumer is strong. And then you hear a lot about this discussion about different rates of growth among different income terciles or thirds. So if we look at the bottom third, middle third, and top third American income people in the Bank of America customer base, we do see differences, i.e. the higher income and middle income are growing faster. But even the lower income third is still growing, and that's all good. And that means, why is that true? Companies are employing people, they're paying people. Now the labor market's got a little soft, and as we look forward at 4.5, 4.6 unemployment, that is gotten worse, so to speak, than it was at the beginning of the year. But frankly, this goes back to the normalization question. If you look at the 10-year average unemployment, the 20-year, the 30-year, or 40-year, it's 5 and 6%, as you go back through time. And so a 4.5 to 4.6 unemployment rate is a very strong relative unemployment rate. It's just a lot of the years it's been below 4.5% has actually been in the last 10 years. So people are very used to numbers now, which were part of the tightness in labor in the 2017, 18, 19 era. Then you had the pandemic and it retightened. And so it's normalizing, but we feel good about all that. And the consumer's in pretty good shape, spending more money, employed and earning more money, but differences between different types of consumers, and then being wise in how they spend. If they trade down, and all the things you're hearing the retailers talk about are true, but the aggregate amount of moving in the economy is still growing.
So you mentioned flattening out in the employment growth. There are always risks to the upside and the downside in any of the numbers that we project. How concerned are you about the downside? Because certainly the Fed is very focused on a softening labor market and whether that may be a problem for us. So
if you look at the predictions for our team and the other economists for unemployment, we're kind of peaking out at this level now in the mid to 4.5, 4.6 range, and then it sort of flattens out. But the Fed has to be wary because they have a mandate to maintain full employment, and we're at full employment now. And they have a mandate to maintain price stability and inflation fighting. And those two mandates can work together sometimes and against each other sometimes. And right now we're in that unusual case where the labor market has softened, and yet the inflation, because the massive buildup inflation after COVID and stuff is now still working its way down. Our team predicts that the inflation rate will get to the Fed's target, through the end of 27, but it's continuing to work in the right direction, which gives the Fed, in our view, latitude to keep cutting rates next year, especially in the first half. That will then provide a stimulus in the second half of the year. Those rate cuts do benefit the consumer somewhat, but in fact benefit small businesses because in mid-sized business, they borrow on lines of credit, which are floating rate indices. And as rates come down, they get instantaneous benefit. And if you hear our small and medium-sized businesses, they're pretty optimistic about next year, telling us they expect to grow, they expect to hire more people. And those small businesses are the backbone of the U.S. economy. We're the largest small business lender in the U.S. economy, so we see them being very active.
This year has been good for the markets. It's also been good for Bank of America. What do you need in 26 to continue the growth?
Look, we just need our team that's done a great job for us over the last several decades to keep doing it. And what they need to do is go out and get one more client and do one more thing with every client we have. And they know that across all of business, whether it's our markets teams, whether it's our global corporate investment bank teams, our consumer teams, our wealth management teams, all of them need to go out and just drive more business. And that organic growth engine, which we described in our investor day a while back, that is intact. It's been growing with the market. And now, because of some dynamics in the repricing the balance sheet, we'll get more earnings lift out of it like we did in the third quarter. But that organic growth engine, more customers and more with each customer, has been driving a Bank of America, and our team just needs to do more of that, and they know that.
That was, of course, David Weston speaking with Bank of America CEO Brian Moynihan. I have to say, Scarlett, he was very optimistic about where we are right now, the state of the consumer. They're still going out spending. Of course, the issue is the top 10% are really going out spending, and the bottom 10% are struggling.
And that spending by the top 10% can make up for a lot of things, can mask a lot of things.
We saw that in the GDP report.
Absolutely. Brian Moynihan, by the way, the second longest serving bank CEO among the big banks, after, of course, Jamie Dimon of JP Morgan. But in terms of annual returns in Bank of America shares, about 13.6% since his tenure began back in 2014.
All right, come at the program. Jobless claims on deck. Stephanie Roth of Wolf Research helps us break them down. We get a little bit more data before you get to go home for Christmas. You're watching Bloomberg Surveillance. Good morning and welcome to Bloomberg Surveillance. I'm Annmarie Hordern alongside Scarlett Fu this morning. We do have equities unchanged after the S&P 500 yesterday hit another record high, 38th record high of 2025.
I'm glad you're counting.
Still a few more days left of the year that we can potentially, maybe get to 40, 41. Let's see. All the action, though, has been in the commodity space. Ignore the fact that it says that gold is down 0.1% because it's up more than 70% this year. Silver is up more than 150% this year. And individuals are talking about higher trends for the commodity space next year as well. So this is something you don't want to miss. All right, we are getting some data. There is still data creeping out before the Christmas holiday. Initial jobless claims, Scarlett, coming in at 214,000.
Right, and that is lower than expected. The estimate was for 224,000, and on a 4-week basis, the 4-week moving average, it's about 216,000, which is slightly lower than the previous 4-week period. On a continuing claims basis, we're looking at 1.9 in terms of the claims for overall, and that's compared with 1.90 as the consensus. So these are, it's a high-frequency data point. It's something that we look at more carefully because the jobs numbers have been messed up by the government shutdown. We haven't gotten a lot of clarity on it, and we probably won't get a lot of clarity on those jobs numbers for a couple of months to come, especially if there's another shutdown potentially in January.
Absolutely. The distortion from the jobs, from the shutdown, longest in history. What's interesting, though, is the continuing claims. That is ticking higher, even though we do have the initial claims a little bit softer. But to Scarlett's point, These data points really do matter, given the fact that we are dealing with potentially this distorted data. Right now, financial markets, though, not seeing really any action. Low volume today. It is Christmas, so potentially some individuals not really paying attention to their eco screen. Joining us now, though, to discuss more, Stephanie Roth of Wolfe Research and Bloomberg's Michael Ball. Thank you both for joining us, being in studio. Merry Christmas to both of you. Let's just get your reaction, Stephanie, from the initial claims number.
It's the data looks solid. It's telling us the labor market remains fairly well contained. The layoffs are pretty minimal. There was a bounce back in continuing claims. We have to remember that there was volatility around the Thanksgiving holiday. The trend, it seems like, in continuing claims is it's actually starting to tick down over the past couple of weeks, which is a positive sign. Continuing claims are important to watch to gauge to what extent people who are currently unemployed are finding jobs, the job finding rate.
When you look at this data and compare it to what we saw in the latest jobs report, with the unemployment rate actually ticking higher, though, what do you make of all of it, or is it just too noisy?
I wouldn't read into the unemployment rate ticking up in the most recent print. I think there was an amount of the government shutdown that filtered into the data. BLS said that there was an impact from the government shutdown. They can't necessarily quantify exactly how much. I firmly believe that in the next December print, we will see that unemployment rate ticking down to potentially 4.4, if not at least 4.5.
Michael, what do you make of this?
Yeah, the timing was different too, right? So the reentries from sort of the college kids coming home had a factor. There was this sort of weirder feel to it that made it very questionable, again, with every other data set we've seen from sort of the shutdown. So again, traders are looking through it, waiting for January to get the December data with the hope it's cleaner. But to what you just said, uncertain if we will get that if there's a shutdown. Lots of questions, not a lot of answers. And
We've been there before. So, Michael, given all of this, the fact that the labor data is going to be not corrupted but incomplete for a while, do you then look at the market focusing more on things like the weekly jobless claims, which didn't really get as affected by the government shutdown because these are state-compiled numbers?
Yeah, I think the continuing claims is interesting. You did see some of that picked up in other survey data. And also what I'm looking at a lot is now the Beige Book. The trending there has been much weaker. You have obviously 3 points, growth, inflation, and the labor market there, where you can kind of extract a trend, and all of it's been sort of negative, including the inflation, which has seemed to be stabilized, moved sort of from the forefront in the summer now to something secondary. And instead now guys are talking about lower sales, lower activity, lower investment. And we saw some of that a little bit in the third quarter GDP, where the investment side was much kind of flatter than you would expect. Now, there was an inventory drag, clearly, and most of the power came from consumption. But my worry is if we move past the AI pulse, the investment CapEx story is much weaker, and some of the PMIs are reflecting that now.
So for those who don't know, the Beige Book compiles anecdotal evidence of what different Fed regions see taking place in their district. Is that based on activity or is it based on sentiment? Because we know the soft surveys tend to show consumers feeling worried, but in the end, they end up spending anyway.
100%. It's sentiment-based for sure. They obviously are, talking about real activity. And the Fed presidents and some of the governors like to say they talk to contacts in their districts or contacts out there. And this is what they're referring to in a lot of ways. But to your point, the shutdown weighed on sentiment. We obviously have seen consumer confidence hasn't really rebounded yet. Business sentiment has been muddling through. If you look at some of the regional Fed PMIs, it can be quite funny when you look at the comments and how frustrated they are with tariffs and with shutdowns.
And of course, it's not just the jobs data that is, left kind of incomplete, Stephanie. We also see inflation, and the latest inflation report was a good example of that, where we're not getting the full picture. And it looks like we're not going to get the full picture for a while.
No, what we're going to see is the inflation data is likely to tick higher in the next couple months. And up until April, when we get the bounce back in terms of rent inflation, given some assumptions that BLS made. So what we'll probably see is an environment where inflation is ticking higher. And I would actually take the other side on the growth from a growth perspective. And our expectation is that growth is going to start picking up. It's already seems to be inflecting to some extent. The Q3 GDP data were actually pretty decent. And my expectation is in Q1, the narrative around the economy will be somewhat the opposite of what we've seen in the past couple months, where inflation is a little bit elevated and growth is also picking up.
When it comes to growth, we had the GDP report for the third quarter, rear view mirror, but more than 4%, absolutely stellar. I know the Commerce Secretary thinks that means we're all getting a 4.3% raise.
If it were true.
That would be great. Our management, if you're watching, the Commerce Secretary says that's what it is. But when you see that kind of growth, do you think that's sustainable into 2026?
No, and first of all, 4.3% real GDP growth does not mean nominal wages. That's a different concept. But putting that aside,
take it up with the Commerce Secretary, Stephanie.
Putting that aside. Is it sustainable? No, because some of it was linked to net trade, which added 1.6 percentage points. what we're seeing is an economy that's running between around 2.5%. Our expectation is we'll be running around that trajectory for 2026. A 4% pace, absolutely not sustainable, nor is that really the underlying trend anyway.
And it got the attention of the president. He said the financial news today was great. GDP is up more than 4% as opposed to predicted. But the modern market, when you have good news, the market stays even or goes down because Wall Street's heads are wired differently. And he says no one that agrees with him cannot become the Fed chair. What does the Fed do with this kind of mix match you're really describing?
I think they're going to be on hold for a lot of next year, at least until we get the new chair. This is probably Powell's last cut. It's an environment where inflation is ticking higher, like I said. Employment's likely to start improving. So unemployment rate, like we talked about earlier, ticking down. And then the trend in payrolls is likely to be a bit better, in which case it's a tough environment for them to be cutting. So the president may very well not like what he's seeing in the first part of the year because the Fed's unlikely to be able to ease policy much.
Unless the data shows that the labor market is deteriorating so quickly, bad headline numbers leading to a good market outcome. The president has made clear he doesn't like that, but will he just take it in the end?
Yeah, I mean, we'd have to have quite a print in January for the December data to make it just right so that they would move. And to your point, then it's no longer risk management cuts. The market takes it totally different. You're cutting now into weakness, and that's a totally different vibe to talk about what Lisa likes to talk about with the vibes. I know she's not here today, but that changes the whole vibe, right? The rotation, the reacceleration, and I understand, what you're saying, that basically there is this hope that the budget bill and that basically the passing of the uncertainty from the shutdown, from the tariffs, will all have a better sort of pulse into the first half of next year. And that's why we've seen this rotation trade, small caps, cyclicals, even pockets of value have outperformed. But overall, again, the worry is that now the Fed further easing is not based on sort of that good vibe. It's just based on worries and weakness, and then people have to change the sentiment.
Stephanie, what is your biggest concern? What is the most high impact but low probability event that could happen?
In 2026, I would say if we're wrong on the labor market, right, and we see the unemployment rate notably ticking higher, that would, of course, be a sort of negative backdrop. Granted, the Fed in that environment, in theory, would be able to ease unless we get inflation starting to tick higher. Not our view, but if we have an environment where you see both sides of the Fed's mandate come into challenge and the inflation side is starting to really pick up, which is very possible in Q1 in particular because Q1 tends to have seasonal problems, that would be kind of the worst environment.
A question for both of you. Is there potential for recession in 2026?
I don't think the odds are particularly high. I don't think they're particularly higher than the normal recessionary odds, somewhere between 15 and 20%. Of course, the odds are never zero, but I don't think it's abnormally high at this backdrop.
I guess a question I have just, percolating in the back of my mind is what does it mean if the AI trade is real and we actually see mass layoffs?
That's not necessarily a recessionary backdrop. Of course, it depends on how it all plays out. If we see an environment where the unemployment rate is just steadily moving slightly higher because you have AI, then you have strong growth, productivity, low inflation. That's not necessarily the worst backdrop. If it's mass layoffs, then they come quite quickly. Of course, that's a very different environment. But I think the way it might play out, if it's really AI related, is a more gradual upward pressure on the unemployment rate, which is not recessionary.
Michael?
Yeah, I think you need a shock, something unforeseeable in a lot of ways to get us there, given the momentum is still strong. Again, what I was saying earlier, I'm worried about this CapEx pulse outside of AI. The no hire, no fire seems to be holding. And as we're seeing now, although December looked to have cooled, the consumer has been resilient. Clearly it was in third quarter. We'll see what happens in the fourth. And that's all driving us into the new year with some good momentum. But to the point, there is still a real concern with price levels, not necessarily the acceleration of prices, but the actual levels still weighing on real disposable income and hurting the K economy, creating the K economy and hurting the lower half.
The dollar is projected to be lower in 2026 as well. And of course, we see central banks around the rest of the world, in the UK, Europe, cutting interest rates. Talk a little bit about how the dollar factors into all of this.
Yeah, the dollar is the big debate, and I think it's interesting because you can spin a number of ways. If we do reaccelerate and there are less Fed cuts for good reasons, one would think that just rate differentials alone would support the dollar broadly. Now, of course, there's all these idiosyncratic stories with the euro, with the yen, and even elsewhere on the other G10s that make it hard to really look at the basket and say, okay, we're going to have one move in the basket. But overall, I think it's just going to be more of an alpha from individual crosses. And on the MLive team, we've been having this debate quite vigorously lately.
Stephanie, it's the day before Christmas. It's Christmas Eve. So, of course, there's going to be a lot of people out there doing some last-minute shopping. Consumer spending, retail sales will continue to hold up for December?
Yeah, I think it should be pretty decent. If you look at the real-time data, they look fairly steady. It seems that the consumer just continues to be fairly resilient. And then in 2026, at the beginning of the year, is when you're going to start to get the impact from One Big Beautiful Bill, which then benefits some of the lower-end consumers from no tax on tips, no tax on overtime via tax refunds that come in.
And potentially $2,000 checks. President's floating tariff dividend checks. Let's see.
I don't know about that.
Let's see what Congress has to say about it. Stephanie Roth of Wolfe Research and Bloomberg's Michael Ball. Thank you both for coming and joining us in studio, spending your Christmas Eve morning with us. Let's get you an update on stories we're watching elsewhere. Here's your Bloomberg Brief with Yahira. Hi, Yahira.
Hi, Annmarie. Recapping the labor market data we just got, jobless claims for last week came in at 214,000. Slightly lower than estimates, which called for an increase of 224,000. It's also down from the prior week, which also totaled 224,000 and brings the 4-week moving average to 216,000. Continuing claims came in at 1.92 million, which were above expectations of 1.9 million. Meanwhile, the Trump administration introducing a new drug pricing model to allow Medicare and Medicaid to cover GLP-1s. The voluntary model would allow the administration to negotiate directly with manufacturers for lower prices and standardized coverage. The model will launch in Medicaid as early as May 2026 and in Medicare in January 2027. And ending on alternative assets, WWE wrestler and influencer Logan Paul is selling a rare Pokemon Pikachu Illustrator trading card. Paul bought the card for almost $5.3 million in 2021. The card will be auctioned on January 12th and is expected to fetch between $7 million and $12 million. In an interview on Bloomberg TV, Paul said the Pokemon market is hotter than it's ever been. Pokemon will celebrate its 30th anniversary in 2026. Keep your Pokemon cards. That's your Bloomberg Brief, Annmarie.
Well, I can't keep my Pokemon cards because I was never part of this phase growing up. I was never
on board with this, are you?
No, I find it kind of weird, to be honest. All right, up next in the program, Anisha Sherman of Bernstein on retail's winners and losers. I guess Pokemon is one of the winners this holiday season. You're watching Bloomberg Surveillance.
There's a pro-cyclical message coming out of this market, and you also have a very important uptrend in earnings estimates and GDP estimates. And this has been the key fundamental underpinning as to why we keep being able to press to new highs. It could be in an environment where we're still able to carve out new highs because of those earnings estimates, but there could be some volatility and chop along the way. Respect the trend, but don't ignore the risks as we go into 2026.
That was Cameron Dawson of New Edge Wealth joining us earlier. Today, we are, of course, are Christmas Eve. The president did say this is now a national holiday, but the stock market's exchanges head said, no, we're not giving you that. S&P 500 futures are unchanged. The equity market will close at 1 p.m. today. We should note we are in the middle of the Santa Claus rally because yesterday it closed for a 38th record high. Let's get you some more morning movers this morning in terms of corporates that has caught Yahira's eye. Hey, Yahira.
Hi, Annmarie. We start with Dynavax, a big mover to the upside. Shares are surging nearly 40% now in the pre-market after French drug maker Sanofi bought the company in a $2.2 billion cash deal in an effort to expand its vaccine portfolio. But the most fascinating part about this deal was the timing, because the statement came out just minutes after the FDA dealt a blow to Sanofi by rejecting its treatment to treat MS. Meanwhile, we are seeing Intel shares sliding in the pre-market, down 3.2% now on a Reuters report that Nvidia paused testing to make chips using Intel's chip-making process known as 18A. And of course, this is a problem because this type of advanced chip manufacturing is central to Intel's turnaround strategy and in its efforts to take on the big chip manufacturer over in Taiwan, TSMC. And I did want to note that Intel did respond to this report, saying that its 18A manufacturing technology is progressing well and that it continues to see strong interest. And we end on Nike, those shares rising up 2.7% in the pre-market after Apple CEO Tim Cook stepped in to buy the dip. He is a member of Nike's board and he bought $3 million worth of shares after the stock plunged last week due to disappointing earnings. Annmarie?
Thanks so much, Yahaya, for all your work today and this year. Sticking with retail on this Christmas Eve, will it be happy holidays for the retailers? Anisha Sherman of Bernstein writing, quote, "We continue to see higher income consumers spending more while middle income consumers trade down towards value. Mainstream retailers are attempting to capture trade down by offering more value as the middle continues to hollow out." Anisha joins us now. Anisha, before we begin, I'm looking at NORAD. Santa was last spotted in Australia. Just give us a sense of how you think this holiday season specifically is shaping up.
I think it's going to be fairly healthy. So we exited Q3 with really strong data across the soft lines and specialty retail and discretionary retail sector. Inventories are lean. Consumers are absorbing those price increases, and we haven't seen a big pullback in volume. And there isn't a huge amount of discounting into this holiday season. So all of that suggests that holiday this year should have both strong top line as well as strong margins without a ton of discounting and markdowns coming out of the season. So I expect some good prints coming out of holiday, and I think the consumer continues to be resilient.
Well, then explain this. How did yesterday the consumer once again feel the heat, confidence slipping for a fifth straight month?
It's a great question. We have seen consumer sentiment down through this year, and spending still remains up. I think part of the reason is when you ask consumers about sentiment in all these consumer confidence and sentiment surveys, you're really asking them about their view of the future, and there's so much uncertainty in the future. So it encompasses some of that uncertainty, but spending is a real-time data point, and spending, and particularly on goods, has been fairly strong. We've seen it cave in other sectors, like restaurants, for example, but goods spending, particularly into the holidays, has continued to be strong. And we're seeing a lot of trade down into value. So some of the value retailers are gaining market share as consumers are looking for more value-sensitive places to shop.
Yeah, watch what they do, not what they say. And to your point about value retailers, this K-shaped economy has split us into premium and value. Both of those are outperforming. And of course, the middle continues to hollow out. So if you are a specialty retailer that's long targeted the middle, that's relied on that middle, you've got to make a call. Do you then pick between either premium or value? Because you can't do everything, right?
That's exactly what we're seeing. So for example, some of the department stores, their premium products, so Bloomingdale's within Macy's, is doing well. And then the mainstream banner is pulling back down into value. So they're trying to straddle that and be able to capture both sides. But for most retailers with only a single banner, yeah, you have to pick. You can't be both. So the retailers that are gearing more towards value, and this can be value at different price points. So TJX is a great example that offers value even at higher price points. They're gaining market share. And some of the premium names, like someone like a Tapestry that sells premium handbags, affordable luxury or luxury handbags under the Coach umbrella, that's doing really well too. It's the middle that's struggling a little bit more.
I feel like premium is always the obvious route because otherwise you are left competing with Walmart or TJX, which are pretty formidable competitors.
Yes, and that continues to be true. On your previous segment, you were talking about the fiscal stimulus coming in 2026. I think premium is going to continue to benefit from that as middle to higher income consumers get more dollars in their pocket. Particularly on the discretionary side, this is going to drive some more spending on the premium end. So that will continue. Those stocks will continue to hold their multiples and trade higher than they have in the past because there is expectation that premium continues to gain market share.
Anisha, when it comes to tariffs, have we seen any of these corporations and companies significantly pass on cost to consumers?
Yes, absolutely. So we've seen both cost side mitigation in terms of renegotiating with suppliers and trying to find cost efficiencies, as well as demand side, which is pushing pricing. And across the discretionary retail sector, price increases have ranged from about mid-single digits to low double digits, depending on the category, depending on the company. And the interesting part, which was quite unexpected, is for the most part, the consumers have absorbed this. We have not seen a commensurate pullback in volume, which suggests that price elasticity has been fairly low. And that's the surprising part. And that's what gives me confidence into this holiday season that we'll continue to see resilience on the consumer spend.
What individual names do you like this holiday season?
So we talked about TJX. I think they will continue to gain share. We talked about Tapestry. I think on the premium end, that is going to continue to be a winner. And then there are a couple of names in my coverage that are just completely dislocated. They've done really well fundamentally, but the stocks have derated. So examples of those are On, the footwear company, Adidas, also a footwear company. They've both derated despite really strong performance. And so there's much more multiple upside there. So there's a little bit of earnings upside as well, but there's a lot more opportunity to catch up on the multiple, particularly if we see a rotation into consumer discretionary in the first quarter.
What happens to names like Nike and Lululemon? We've seen them struggling. We've seen them trying to figure out what their identity is right now, and they haven't quite gotten there yet.
Yeah, the market has not had a ton of patience for turnaround stories this year. There have been a lot more safer bets that people have been rotating their money into. And so if you're a turnaround story, particularly if you're subject to political risk and tariff risk and consumer spending risk, the market hasn't had a lot of time for that. So, I like Nike. I think Nike's turnaround on a multi-year basis is very powerful. But I think, they reported last week and they essentially indicated that the turnaround would be slow, that it's not going to be a rapid bump, and the market didn't appreciate that. So I think it's going to be a slower burn. Lululemon is maybe even earlier stage because they've just had a CEO exit. They haven't named their incoming CEO yet. There's probably going to be a new strategy in place. So they're a little bit earlier stage even. Both stocks, I think, have some upside, but I think we have to wait a little bit. It's not going to be immediate.
Anisha, thanks so much for your time this morning. Merry Christmas to you and your family. Anisha Sherman of Bernstein. Scarlett, who also likes Nike? Tim Cook.
Tim Cook is a big fan of Nike sneakers. Of course, he's a longtime board member as well.
Yeah, of course. He likes the shares today, and he does for sure like their trainers and their sneakers. That does it for us. Happy holidays and Merry Christmas from the entire team here at Bloomberg Surveillance. Scarlett and I will be back Friday. We have a stacked lineup, including George Concalves of MUFG, Sarah Kunst of Clio Capital, and Victoria Fernandez of Crossmark. This was Bloomberg Surveillance. If you were watching on this Christmas Eve, thank you for joining us and choosing us, and Merry Christmas and Happy Holidays to you and your family.